And here are your top stories. Sea of red. Global stocks plunge, bond yields surge as unrelating inflation heaps pressure on the Fed to step up rate hikes. The yen sinks to a 24-year low. Crypto crumbles, Bitcoin plunges to the lowest in 18 months as the US inflation impact spreads. And the UK economy shrinks more than expected in April. Problems mount for the Bank of England and the government.
Now, Tom, let's look at the futures. It's all about inflation. Of course, the Fed, the big one, but it's also Bank of England probably looking at that GDP figure. For the moment, FTSE futures down 1%, DAX futures down 1.4%. And again, it's this inflation versus recession conundrum that central banks have to deal with.
The bigger than expected CPI print on Friday out of the US, 8.6%. The market's repriced aggressively with a sell-off in bonds, in treasuries, in the peripherals. And now the expectation from some in the markets, you could get as much as 75 basis points this week from the Federal Reserve. It isn't the consensus, but Jefferies and Barclays certainly putting that on the table. And to Francine's point then, a faster rate hike cycle, then bringing forward the question of a recession, the recessionary risks. Currently, the Spanish IBEX down 1.4%, down 118 points over in Spain. The FTSE 100 lower by 0.8%, with our own idiosyncratic growth picture as well. That contraction that we saw in the month of April, month on month, and then the conundrum for the government and the BOE, which of course makes its decision later this week. The French CAC 40 down 1.6%. There's also the politics at play there as well. The first round of parliamentary elections were on Sunday. The second round next week. There's question marks over what it could mean if Macron doesn't get a majority and for his reform agenda. Let's switch it on and see how things are playing in across assets. The heavy selling that we saw on Friday in the United States and in Europe, it was a week of losses, of course, overall. The Nasdaq futures pointing to losses of 2.2%. Of course, tech heavy, the most exposed to that run up in yields that we're seeing. The yen remains in focus for us. 134 did cross above 135 at the weakest level in 24 years. We heard from the Bank of Japan's Kuroda saying that they will continue their easing policy. And of course, it is that rate differential that's putting pressure on the yen. We've seen buying as well of JGBs by the Bank of Japan this morning. The US 2-year currently at 3.17, yield curve flattening, and in fact, inversion for the 5s and 30s. Another jump, look at that, 10 basis points for the US 2-year. And Bitcoin, as mentioned in the headlines, under pressure. The crypto space crushed 25,350, down more than 7%. Francine.
Tom, if you look at the sector, so no one is in the green. You can see a sea of red actually beneath me. Travel and leisure, technology down between 2.2 and 1%. Energy, basic resources also significantly on the way down. Overall, you can see the European stocks down some 1.2%. And then the ones that are losing the least are still losing, and that's healthcare, some of the consumer products down between 0.3% and 0.6%, Tom.
And we're looking at Rio Tinto, some of the miners under pressure as a result of seen in terms of iron ore. Iron ore has fallen pretty sharply this morning on concerns China. The other factor, we have the inflation print, but also China, and the fact that restrictions have been put in place again on Monday in some cities, including Beijing and Shanghai, as they wrestle again with another flare-up in terms of COVID-0. The demand picture then for iron ore, the implications for the miners. Rio Tinto down 1.2%. This is a builder here in the UK, just down 0.3%, maybe an issue around selling part of the business for that developer. And Atos looking at repackaging its IT services. down 7.5% for this French-listed company. Okay, Treasury yields surging across the curve, as I mentioned, with the 2-year rising to its highest level since late 2007. That as the US inflation shock continues to rumble through markets, with investors now rushing to price in more aggressive Fed hikes to counter the hottest consumer prices in 4 decades. Here is what our guests have had to say.
We see inflation continue to ripple through the economy and wreak havoc.
Certainly the drivers of inflation have broadened out.
Broadening and deepening out.
Everybody knows that inflation is going to be sticky.
Inflation is going to be stickier at a much higher level.
More clarity from the Fed is what's needed for the equity market to find its footing.
The Fed has more work to do.
More to do in the coming weeks and in the coming months.
Rates need to go significantly higher.
Beyond 3.5%.
Between 50 and 75 basis points.
Can the Fed pause in September? Well, we know that the answer to that now is no.
I don't think anybody thinks that we're going to get out of this without interest rates being significantly higher than they are right now.
Let's get some of the key drivers, market drivers, with the markets editor, Ven Ram. Ven, a lot going on certainly in the space that you follow very closely, which is fixed income. What will be repriced this week?
Francine, a lot will be repriced this week. Obviously, we have seen the repricing in overnight index swaps, and that means that treasury yields have to reprice higher, and then currencies, particularly the dollar, will be bid, and stocks will go head lower. This is a pretty familiar script, given what's going to happen to the discount rate that is applied to value stocks and currencies. And specifically on the 2-year yield in treasuries, we are going to see an upsurge because those rates may go to 350 plus because of what the Fed is likely to do in response to that inflation print.
And they could, according to some, put 75 basis points on the table. What would that do for fixed income then?
Morning, Tom. I don't think they're going to go 75 basis points. If you look at the OI's pricing for this week, we are pricing just about 50 basis points and a fraction more. So I don't think this is a Fed. This is a Fed that wants to show its hand before it delivers what it delivers. So I don't think we are going to get 75 basis points. This week, we'll get 50 basis points, and then it'll be interesting to see whether Powell says they are willing to go at a 75 basis points pace from next month onwards. In any case, the markets are saying, look, regardless of whether it's 75 basis points or 50 basis points, we are going to get another 250 basis points of hikes in the remainder of the year. And that's a pretty damning statement on treasuries and stocks, because that's going to sink treasuries and that's going to sink stocks.
Ven, where do you see the most? I mean, when you look at the, how global markets are really repricing a lot of the stocks because of that inflation print in the U.S., is there a risk now that they're getting ahead of themselves of what the Fed will do?
The markets are over-exuberant in pricing what the Fed could be doing. I think that, given the kind of inflation that we have seen, given that, the peak inflation narrative is kind of petering out. We said that peak inflation was supposed to have been in March. It's not happened clearly. And if this is going to be how resilient inflation is and how stubborn inflation is, then the Fed will have to go at this pace. That's the minimum required pace that the Fed will have to go at. And stocks and treasuries will just have to adjust lower.
Ven, I want to get your thoughts on the BOJ, because we've heard from Kuroda on a day when, of course, the yen has fallen to a 24-year low. We've seen buying of JGBs, and we've seen the 10-year getting to 25 basis points. Are we going to see capitulation from the BOJ?
Well, I mean, we are already seeing some kind of capitulation from the BOJ. Just a few days ago, Kuroda was on record as saying that the exchange rate is not the target of the central bank. This morning, he has come out to say that, look, I mean, the drop in the yen is having an adverse effect on the economy. Clearly is calibrating his stance and knowing that, the yen is falling more and more and more and with greater velocity each time. And in the fixed income markets, what we have seen today is that the 10-year JGB yield has gone past 25 basis points. Now, 25 basis points is the absolute line in the sand for the BOJ. And if it goes past that, the BOJ has a massive problem on its hands. And they are saying that they are going to stampede the market with more bond purchases tomorrow at the scheduled bond buying operations. So we've got an very interesting development in the case of Japan. And if the Bank of Japan doesn't come out and raise its rhetoric and show the markets that it means business on the yen, we are going to see the yen tank even more.
Okay, the challenge is there for the BOJ. In fact, all central bankers, of course. Ven Ram, thank you for walking us through what is happening, the repricing in this fixed income market on, of course, this high inflation print, the challenges for the Federal Reserve. Coming up, crypto takes a beating as the latest US inflation data sours market sentiment, currently trading around $25,000. We'll discuss that next. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Welcome back to the Open, everyone. We are 11 minutes into the European trading day, and this is a picture overall for equities. Now, we are seeing quite a lot of pressure on the European stock 600, down 1%, the DAX, the CAC down 1.2%. Again, there's a global exodus from stocks as they're trying to look at what exactly investors think about inflation going forward after that CPI print from the US, and of course, whether that will force central banks to squash economic growth with higher interest rates. Now, to talk about this and much more is Wei Li, Global Chief Investment Strategist at BlackRock Investment Institute. Wei, good morning. First of all, I was going to go straight into why the markets are so red. When you look at this global exodus, how long more does it have to run?
Well, what's going on right now is precisely why we recently downgraded developed market equities, because markets are primed to interpret every near-term inflation prints hawkishly and potentially overdoing it, right? And near-term inflation prints are very hard to predict from month to month. We can say over the long term, supply bottlenecks could resolve themselves to some extent and inflation could come down. But near-term is really, really hard to predict, and markets are primed to really read and overread hawkishly into these prints, which is why we lowered our risk taking and we downgraded developed market equities, and we want to kind of stay bunkering down until later down in the year when inflation pressure eases a little bit.
I mean, bunkering down seems like the right phrase on a day like today. What would a 75 basis point move from the Fed? I know it's not consensus at this point, but if you did and were to get 75 basis point, if not this month, then in July, what would that mean for risk assets?
Well, I think that would send panic signals across global markets, right? Because so far they've signaled 50 bips back to back and potentially more in September and beyond, but 75 bips was not really kind of talked about. So if they keep that door open in the same way that ECB keeping 50 bips open and that sent kind of panic across markets last Thursday, we certainly could see a repeat of that. That's not our base case at this juncture, but so much focus is around the politics of inflation, which is to be very tough sounding on inflation. So we could see further kind of hawkish chatter dampening market sentiment, but at some point we do expect the focus to go from the politics of inflation to the economics of inflation, and that's when things could.
Wait, this seems like almost a very philosophical question, which is, can the Fed at this point engineer a soft landing, or do they really have to choose between, risking a recession and dealing with inflation?
Well, given the supply-driven nature of the macro environment, there really isn't a Goldilocks environment, a Goldilocks option on the table. So we do believe that the Fed will have to live with inflation because of the supply-driven nature of inflation, in the same way that ECB and central banks globally will have to live with inflation. So ultimately, we do expect a bit of a dovish pivot from central banks when inflationary pressure eases and the focus goes to the economics of inflation and the consideration about hiking rates on labor market, on the economy. But at this point, we don't see that
What is the time frame for that dovish pivot? Because that's crucial, isn't it, in terms of how you position? And do you still think the markets are ahead of their skis, over their skis, when it comes to pricing of ECB hikes, given what we've seen in terms of the repricing just over the last couple of days?
I think ECB pricing is really aggressive, right? We're talking about more than 1% higher than neutral rate estimates. So we're talking about the ECB, if were to deliver the number of rate hikes priced in by markets, potentially driving the economy into a recession firmly. And that is not the calculus, in our view, in the medium term for the central bank. So we do expect dovish pivot later down the line, but for as long...
This year, or are you looking into 2023?
The key is very much around where inflation will be at the year end. So we're looking at potentially full handle for the US, and that may be enough for them to kind of communicate a bit of a dovish pivot, but that's much later.
But wait, a dovish pivot would not be a rate cut, or could it be a rate cut?
Oh, no, just kind of signaling that their willingness to live with inflation, and this is a different environment compared to pre-pandemic levels.
Wait, ECB, I mean, this is something that we were talking about, right? Is the ECB the one that maybe markets are most worried about?
Well, at this juncture, given the more dire growth inflation trade-off in euro area because of the tragic war happening in Ukraine and euro area economies being more kind of impacted by that, indeed, ECB is in a more tricky position than the Fed. Inflation is getting pushed up more in euro area compared with the US, and growth is being dragged down more than the US economy because of the energy crisis. So ECB, the growth inflation trade-off is coming to a head, and we do believe that the pricing is too hawkish, but the time to kind of turn more dovishly is not now because of the eye-watering inflationary pressure.
What is looking attractive, if anything, within the fixed income space? Is the front end above 3% on the US 10-year? Is that looking attractive at this point?
Well, over a 6 to 12-month horizon, we do want to kind of long the short end and short the long end. So a steepener view is still our expectation, but more broadly, we are underweight government bonds because of the very elevated inflationary pressure. At this point, we recently upgraded credit from underweight to neutral, but that is also off the back of downgrading broader developed market equities. So there's a bit of a de-risking going on in our portfolio construction at this juncture.
Okay, Wei Li, what a great day to have you on, or at least great to have you on this day, at least. Wei Li, of course, Global Chief Investment Strategist at BlackRock Investment Institute, staying with us. We'll get more of Wei Li's calls after the break. Let's get the Bloomberg Business Flash now with Angel Feliciano. Angel.
Hi, Tom. A study has revealed that a spinoff of HSBC's Asian unit could unlock $26.5 billion, or a fifth of its current market value. The Sunday Times says the research by an external consultant was commissioned by Ping An Insurance, HSBC's biggest shareholder. Bank executives are against the idea of splitting up HSBC and have begun their own analysis to push back against Ping An's argument. Electric Last Mile Solutions says it plans to liquidate through a Chapter 7 bankruptcy process. That decision comes almost 1 year after the electric vehicle startup went public and just 4 months after both its chief executive officer and chairman resigned. The U.S.-based company said late Sunday that its board made the decision to liquidate after it turned up no better option for shareholders and other interested parties. Sources say bids for rights to broadcast Indian Premier League cricket hit nearly $6 billion on the first day of their auction. Amazon pulled out last minute, leaving Mukesh Ambani's Reliance Industries, Disney, and Sony as the leading contenders. They're battling for a 5-year contract for one of the world's most popular sporting events. Bidding resumes Monday. And shares in Korea's Bucket Studio jumped on news that the Netflix hit Squid Game will return for a second season. The studio holds a stake in the agency, representing the show's lead actor. Netflix is betting that a second season may help stymie this year's 70% slump in its own shares after announcing in April that it had lost 200,000 subscribers in the first quarter. And that is your Bloomberg Business Flash. Francine?
Angel, thanks so much. Angel Feliciano here in London. Now, coming up, markets repricing the Fed's tightening path after that very hot CPI print out of the U.S. on Friday. That's piling more pressure on Jay Powell. We have more market insights with BlackRock's Whaley next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Unfortunately, the balance of risks is tilted in the negative way right now. And we have a strong labor market, and that's what's keeping us away from a recession right now. That's why a recession is a risk scenario, not a baseline.
Fed's forecasts have tended to be much too optimistic there, and I hope they'll recognize fully the gravity of the problem. When inflation is as high as it is right now, and unemployment is as low as it is right now, it's almost always been followed within 2 years by inflation, by recession.
Bloomberg columnist Mohamed El-Erian and former U.S. Treasury Secretary Larry Summers there. And still with us is Wei Li, Global Chief Investment Strategist at BlackRock Investment Institute. Wei, where do you position in equities in an environment like this?
Well, we're currently bunkering down. We lowered risk taking. So really there isn't a part of the equity market that we would want to own in an overweight sense, right? We're benchmark weighting, so we're still staying invested, but we're not overweight because we see the near-term environment very challenging from the perspective of elevated inflationary pressure, but also earnings way too optimistic at this point. U.S. earnings are forecast to grow at low double digits. We're talking about 11% EPS growth for this year. There is no way that we can deliver that from U.S. corporates, right? So all of that just goes to show the near-term kind of risk being skewed on the downside, not to mention corporate margin being at a very elevated level in the face of inflationary pressure and labor cost going up. So all of that is why we have lowered risk taking. But at some point, as I said earlier on, we do want to kind of lean into market when we see dovish pivots coming through, but that requires central banks acknowledging the trade-off between growth and inflation and choosing to live with inflation, which is not something that we have seen so far because the politics of inflation is dominating the narrative.
So how do you hedge?
How do we hedge? Currently, we have a curve view, as I briefly just spoke to, which is to go long the short end and short long end. So there is a bit of an element to hedge on the short end / a bit of a cash there as well. But more broadly speaking, the way that we see portfolio construction, you know, like parking allocations to cash for a long time is the definition of cash drag for strategic portfolio allocation, right? So we don't advocate significantly going into cash for a prolonged period of time, but rather we lower risk by when we optimize for portfolio, just decrease the overall risk budget that we get to play with, which then inevitably lends a little bit more to fixed income part of the market, and which is why we recently upgraded investment grade in that spirit.
When it comes to the strength of the consumer, we had the University of Michigan survey out on Friday. It fell to a record low. But the mantra for so long has been that households in the US can hold up because they have so much cash on their balance sheets on aggregate. What is happening with the consumer, and how does that inform your positioning as well within the equity space?
Well, if you think about kind of the fiscal impulses in the U.S., it's slowing down. But for a long time, the expectation is that the consumers would take over the baton and kind of bridge that fiscal cliff and ultimately kind of cushion the growth trajectory. Indeed, consumers sitting on $3 trillion excess dollars are in a reasonably good shape in terms of the household balance sheet, but their willingness to spend in the face of elevated inflation and also in the face of reasonably low real wage growth carries a big question mark. So there is potential for them to come through, but right now, given the very negative sentiment, we wouldn't want to bank on it.
Wait, is there anything in terms of sectors that has pricing power or certain parts of the world that you want to be invested there?
Well, over a strategic period of time, we do still think that sectors like healthcare and also tech to some extent, you know, like demonstrating the potential for explosive earnings growth as well as pricing power should come through. But in the near term, tech clearly taking a bit of a beating as the duration, kind of long duration assets being more sensitive to the rate repricing. So we want to barbell that with energy cyclical exposures as we think about sector allocation.
Wei, thank you so much. As always, great to speak to you. Wei Li, there, Global Chief Investment Strategist at BlackRock Investment Institute. Now, coming up, stagflation fears rise in the UK as the economy shrinks more than expected. More on that story along with the latest on the Northern Ireland Protocol. I mean, Tom and I were wondering exactly what happened to that GDP. It was track and trace. I mean, the dynamics of that are kind of tragic and funny at the same time.
And we've got the BOE, of course, making their decision later this week amid that worsening growth backdrop. Stay with us. This is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Sea of red, global stocks plunge, bond yields surge as unrelenting inflation heaps pressure on the Fed to step up rate hikes. The yen sinks to a 24-year low. Crypto crumbles, Bitcoin plunges to the lowest in 18 months as the U.S. inflation impact spreads. And of course, the UK economy shrinks more than expected in April. Problems mount for the Bank of England and the government. Tom, I mean, things are not looking great over on the markets because now it's kind of like a game of how do you price this ever higher inflation?
Repricing across these markets, whether it's crypto or fixed income or currencies. We had a number of officials out from Japan, from South Korea, from India, all pointing to their concerns about the pressures on their currencies as you see this repricing. 8.6% was that inflation print on Friday, above the estimates, of course. And then across the yield curve, the steepening that you saw, at least in terms of the front end, the yield curve, I should say, was flattening in terms of the bearish. In terms of yields, though, you were seeing a sharp rise higher in yields. And you're seeing that again built on, particularly around the peripheries, and the US 10-year now at 231, the last time I looked, which is the highest level in terms of that yield since about 2018. The benchmark here in Europe is lower by 1.4% after weekly losses for European stocks last week. The DAX is lower by 200 points, down 1.5%. The FTSE 100 lower by 1% as well, with that GDP print coming in contracting for the month of April. The BOE is later this week, so just the pressure on the Bank of England and the government here as the government also pushes ahead with very controversial legislation on that Northern Ireland Protocol. Let's switch it on and see how things are breaking out across the sectors, because it's red across the screen, led by the likes of tech and travel in terms of those losses. Travel down 2.7%, technology lower by 2.3%, autos also down by more than 2%. So it is a grim picture when it comes to the repricing across these equities. We are, of course, shaping up to that higher inflation scenario, and then the risks then, very pronounced risks now for many watching these markets of recession and what you do within that market. The ECB, by the way, this is a line that has crossed ECB, the deposit rate seen at 0.75% in October, implying 2 half-point hikes. So the repricing continues, Francine.
Yeah, it does. And I don't know if we have a board actually looking at some of what we're seeing in European government bonds, but certainly the sell-off that started on Friday is gathering pace as investors again brace for the European Central Bank to raise rates in the coming months to stem accelerating inflation. If you look at the yield on Germany's 2-year government debt, which is probably the most sensitive to changes in policy, that rose above 1%. You can see the 10-year at 1.539 there for Germany. Italy, 3.86. Now, figures out this morning show the UK economy shrank 0.3% in April, raising stagflation fears. For more, we're joined by Bloomberg's Lizzie Burden. Lizzie, now, first of all, a big factor in this data is something, is this like a technical thing that it's down 0.3% because of test and trace, or is it that we should really worry about the underlying conditions?
Well, exactly. It's not a cost of living story as some had predicted it would be. In other words, because you had the rise in the energy price cap, people thought that it would weigh on demand. Rather, it's because you had the end of the free COVID testing weighing on health output. In terms of what it means for the Bank of England this week on Thursday, this might be enough to put some policymakers off 50 basis points if they were thinking about it, though perhaps it's not enough to tempt the doves into voting for no hike at all. On Twitter, economists are saying that 50 basis points is off the table for June now. And in terms of the Bank of England's growth forecasts, the CBI has just downgraded its forecast to 1% for 2023. So the Bank of England might want to follow suit. And also the CBI is calling for more business investment to avoid a recession down the line.
Okay, and when it comes to the government and policy making here in the UK, Lizzie, again, it comes back to that controversial Northern Ireland Protocol.
It does. So the bill that the government is looking to pass and present today will seek to fast-track the flow of goods from Britain to Northern Ireland, separate to goods that are then going on to the EU. Of course, that's going to raise concerns in Brussels about the integrity of the single market. And that's why the focus we're expecting today will be more on the why than the how. There had been concerns about it breaching international law. The Secretary of State for Northern Ireland, Brandon Lewis, insisted yesterday that that is not the case. But this is likely to face blowback from left, right and centre, from the pro-EU MPs in Johnson's party, in the Lords, from Brussels, from the US. But what it really shows is just how beholden Boris Johnson is to the pro-Brexit wing in his party after that vote last week that nearly deposed him.
Okay, Lizzie Burden on the politics and the economics of the UK on a day when, of course, we saw the GDP contract for the month of April, looking ahead to the BOE as well. Thank you. Joining us now is Jumana Salahin, Chief Economist and Head of Vanguard Investment Strategy Group Europe. Jumana, thank you for joining us in the studio. We can start with the UK, we can start with the Fed, we can start with the ECB. Let's pick up from where Lizzie left us then, the contraction that we're seeing here in the UK and the conundrum that that poses for the Bank of England. Can the Bank of England plough ahead with the rate hikes that the markets are now expecting and avoid a deeper recession here in the UK? Are they going to pause, though, the BOE, in fact?
I think they should definitely go ahead with the rate hiking that they have planned because, you know, we have to remember inflation is, you know, high. Latest print was 9%. It's going to rise to 10%. That's 5 times what the target is of 2%. So you've got to bear that in mind, that where inflation is right now is really high. So for the credibility of a low and stable inflation environment, which at the end of the day is good for long-term growth, that's what we're looking for.
I mean, the problem is that I don't know whether, you know, the central banks don't look at it through the credibility lens and they're just firefighting, because is there a concern that they raise so much now and then have to cut in 2024 or even sooner?
That's a really good question, Francine. I think the issue really is, yes, absolutely, delivering that soft landing is going to be quite difficult, right? There is a very, very narrow path to that soft landing, and whether they can navigate themselves or not on that path remains to be seen. But, you know, you have to think about those 2 shocks that you're seeing, right? You might have to give rise to a small recession if that's what it takes to maintain that credibility of inflation low and stable in the long term.
What about the fiscal impulse here in the UK? To what extent can tax cuts that seems are being flagged now by the Chancellor offset some of that tightening at the monetary policy level?
Yeah, absolutely. I mean, you know, fiscal is always going to be a tool that you can use to be offsetting, and we've already seen some of that in the cost of living support that we saw at the end of May. So some of that is going to kind of soften the blow. But I think you have to think about the big picture, which is there is a shock here, which is a series of negative supply side shocks driven by higher commodity prices. And we've seen a further rise in oil prices and energy prices in general, you know, nearly $120 this morning. And I don't think that's been factored into the inflation of 10%. It could actually be higher than that going forward. So I think when you take the whole picture into account, you know, with the stagflationary shock, you have to cool the economy.
Jumana, is there a danger actually that it's almost impossible not to deal with inflation whilst putting growth at risk on borderline recession in Europe and the US?
It's a horrible time to be a central banker, Francine.
When was it ever not a horrible time to be a central banker?
No, it's not. So it's a good time when you're cutting rates, right? And inflation is pretty stable, which it has been over the last 25 years. If we think about the record of the Bank of England, they've done really well. It's only really over the last year that it's kind of, in this sort of stagflationary environment.
When it comes to the peripherals, we're looking at BTPs again today and the blowout in yields there. An 18 basis point jump for the BTPs at the 2-year and 9 basis point jump in terms of the 10-year. Now 386 for the Italian 10-year. So you're looking at around 230 basis points in terms of the spread between the Italian 10-year BTP and the German Bund. The risks for the peripheral and the Eurozone, are we looking potentially at another Eurozone crisis as the ECB tightens without a concrete plan to address the increase in yields that we're seeing in Italy, in Greece, in Spain?
That's definitely what markets are worried about. And with Lagarde's press conference last week, she said, hey, we've got the tools to deal with this, but she hasn't actually said what those tools are, which is why markets are, worried about fragmentation. I mean, I think the only thing I would say is in the past, when it comes to the transmission of monetary policy, they have worried about that. They have pulled those tools out of the bag. Whether they can do that or not remains to be seen. But I think at this stage, we could probably give them the benefit of the doubt.
But there are also rumors, Jumana, that actually, and this was coming from an economist at the IIFs, that certain parts of the governing council thought that yields were too low for too long, and therefore, didn't force some of the periphery to do the structural reforms that they needed. So are markets going to test really the ECB's resolve on this?
Absolutely. I mean, during COVID, there was the pandemic spend that all periphery countries had to make, and debt levels, remained high in those periphery countries, Greece, Italy, Spain. So, the debt levels are high. They're not going to come down quickly. And so absolutely, there will be situations when the markets will be testing that, and that's when the ECB will have to respond.
Which economy at this point that you look at is looking most resilient in the face of all these headwinds?
You mean in the periphery or more generally?
No, generally, the economies that you look at, is there a Eurozone economy that stands out? How you compare the Eurozone to the UK, to the US? Is there one economy that's looking more resilient in the face of 4-decade-high inflation and all the supply constraints and the tightening that we're looking at?
I mean, I think in terms of, if you think about which economy is strongest domestically, I would probably point to the US. In Europe, it probably is, the northern countries, Germany, France are doing better relative to Italy and Spain.
Jumana, thank you so much for joining us. Jumana Salehin there, Chief Economist and Head of Vanguard Investment Strategy Group in Europe. Now let's also look at treasuries because, again, we're going through a huge shift in stocks because of that inflation print in the US, and that, in turn, is feeding through the 10-year in the US, 3.2% there. I mean, it's actually quite incredible how things can move quickly when there's a unexpected surprise in inflation.
Yeah, yield inversion now you're seeing in the 5s and the 30s when it comes to the US, and of course that yield in terms of the yield curve flattening that you're seeing, bearish flattening with the 2s and the 10s as well. So the 2s at 321, the 10s just at 324. And when it comes to the Eurozone, look at the Italian BTPs again for the 2-year at the front end, a jump of 22 basis points. It's mirroring the kind of moves that we saw on Friday. It's building on that, and again brings us back to the question around fragmentation and pressure across the Eurozone. Francine.
Yeah, coming up, crypto takes a beating as the latest U.S. inflation data sours market sentiment. So we look at all risk asset classes. We discuss that next, and this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Commodities are very likely to remain supported because demand is still strong.
Best probably still oil.
Our combined exports of crude oil and petroleum products in recent weeks have been at the 10.5 million barrel a day range. That would make the U.S. the largest liquids provider in the world, bigger than Russia, bigger than Saudi Arabia.
We think that actually at the longer end of the curve in oil, we think is where the opportunity is. At the short data contracts up above 120.
You look at oil at 120. Doesn't seem that expensive.
Of course, we have everything which is related to food, so anything which is corn and wheat.
Wheat, wheat is in short supply.
And that's mostly because all the geopolitical tensions that we're seeing with respect to Ukraine.
We're planning for continued inflation for the foreseeable future.
The combination of the war and the supply and demand imbalances that were already in place before the war began, especially in energy, will really push up ag, base metals, precious metals and energy together.
We're looking at the likes of nickel especially and lithium. They're the two commodities that we think will do very well over the course of this year.
We expect industrial metals to eventually have a bounce back towards the latter half of 2022 as well, given the fact that now we're seeing a rebound in China.
At this stage, we've got a good call for gold, but we don't think that it's going to be the best performer over the rest of this year.
The pressure is going to continue. We are not at the peak yet.
Some of our guests at Bloomberg TV responding then to the latest MLive Pulse survey, which is all about commodities, and you can have your say on this week's survey on your Bloomberg terminal. A redhead crossing the terminal just in the last few seconds. Markets now pricing in 175 basis points of Fed hikes by September, with at least one 75 basis point move. You've got meetings in June, July, and September, so you can do the maths, 50-50 and 75, or however you want to position those, 75 and 50-50. You look at the yield curve. It's the front end of the yield curve where the yields are jumping the most. Again, so that yield curve flattening just very briefly, Francine. It's at the front end. 14 basis point moves on the 2-year, then you go 11 basis points on the 5-year, 7 basis points on the 10, and 5 on the 30. It's the 2-year currently at 320, a 14 basis point move just in today alone, building on the moves that we saw on Friday.
Yeah, they're really trying to get out front of what we had on Friday, and then we had the Barclays and Jefferies call actually changing their call for 75 basis points hike on Wednesday. Now, I would say that, of course, it's all about Jay Powell, what he says this week, how he characterizes inflation, but also forecasts on the Fed funds rates, the so-called dot plot, that will be critical. Now, he pushed back against 75 basis points last time, but then we had, for example, James Bullard saying, well, look, 75 basis points may be worth considering.
If they don't go 75 basis points this week, will they leave the door open? To your point, will they leave the door open? Will Jay Powell leave the door open to 75 basis points in July or September? And of course, the repricing continues in the Eurozone as well, and a very sharp move. And on again, another day where you're seeing 20 basis point moves on the Italian 10-year, 2-year BTP. Let's get to all of this impacting across asset classes, including cryptocurrency. So let's get to cryptocurrencies and Bitcoin, which has plunged to an 18-month low amid a broad sell-off, hitting the major cryptocurrencies. This may signal an ugly start. Well, we are seeing that, an ugly start. It certainly is signaling an ugly start. Everything is ugly this morning. And currently, Bitcoin is priced at 24,000, so below 25,000. It's even worse for Ether. For more on this, let's bring in our crypto czar, Joanna Ossinger. Joanna, what is going on in the crypto markets? Is this all about just general risk off, or is there something idiosyncratic and central to cryptocurrencies that's also at play here?
Yeah, well, a lot of it is risk off, and just the concerns about inflation, the concerns about things like the mega cap tech stocks. But you also have the issue of the Terra Luna meltdown last month. And now today we had crypto lender Celsius freezing withdrawals. And so that has injected this extra bit of uncertainty into the system. I mean, we're on the 7th day of declines. We've already gone well out of that range around 30,000 where Bitcoin was for several months. So it wasn't doing well anyway, but there is a lot more concern just today.
So where does it go next, Joanna? How difficult is it? I mean, what are we tracking? That inflation, or is there another asset class that Bitcoin seems to be mirroring?
Well, it definitely mirrors U.S. stocks to a pretty strong extent at this point. But it's also, inflation is going to be a big thing, just the Fed's rate path. And it just kind of the momentum has really been sagging overall. And other cryptocurrencies like Ether, Avalanche, Dogecoin have even been underperforming Bitcoin. So yes, U.S. stocks is kind of a good general proxy, but the asset class is really subject to this momentum right now, and it just seems all to be downward.
Joanna, thanks so much for joining us. Joanna Ossinger, they're one of our crypto czars looking at Bitcoin and all cryptocurrencies and stablecoins. Now, coming up, Chinese officialdom summons some of the biggest names on Wall Street for dressing down on bankers' pay. We look at the future of global finance in China next. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. Happy Monday or not, depending on how you're positioned in these markets. You're seeing losses of more than 1%, 1.3% across the benchmark here in Europe. We want to zero in on what's happening at the peripheries because we discussed fragmentation. That was in focus at the ECB meeting last week. And you're seeing that start to permeate now in the peripheries, particularly when it comes to the Italian BTPs and the 2-year, where you're seeing a jump today of 18 basis points. You saw a jump of almost 22 basis points earlier in the session. So you're having 3 sessions now, 3 days where the Italian BTPs have jumped close to 20 basis points on those yields. And that spread between the Italian 10-year, which is currently at 384, and the German Bunds at 153 is comfortably above that 230 level, or close to 230 basis points. The screaming level of 250 then, arguably in sight. And will this force action from the ECB, at least commentary, rhetoric maybe, to address these risks?
I mean, if you're a market participant, why would you not test that, right? Just to test the result. I mean, we've seen it in the past. I know we maybe don't have a George Soros at play who tested and broke the Bank of England, but if you're like, you know, holding on to these and they keep on saying we have the tools, right? Where all are those tools, especially as there's so many rumors of certain parts of the governing council not wanting to allay those fears, so that it puts pressure on some of the countries to continue with structural reforms.
And Whaley from BlackRock earlier saying to us that she thinks actually the markets are getting ahead of their skis in terms of how aggressively they're pricing for
getting
the
ahead
ECB.
Of their skis. I love that.
Well, maybe not so appropriate when it's like 25 degrees here in London, the winter analogy, but that was the sentiment. Okay, let's get to what's happening over in Asia and China, particularly around Wall Street's exposure to the world's second largest economy and their attempts to grow their presence there. Wall Street recently summoned some officials there, or some executives, by banking regulators in Shanghai and Beijing. On the agenda, bankers pay. They were told, executives, not to reward their top people too lavishly. It's just the latest of the many potholes that global banks have hit in China. For more on today's Big Take, we are joined by Bloomberg's China finance reporter Kathy Chen, who's been doing all the hard and good work on this story. Kathy, is it unusual to see executives summoned like this by Chinese regulators, Chinese officials?
Yeah, people who actually are familiar with the meetings basically saying this is highly unusual, if not unprecedented. We talked to people in China for 20 years, working there for 20 years. They said they've never seen this. And it's kind of like ironic to see the global banks are taking control of their joint ventures, but now they are being controlled, even us being sort of like scrutinized more severely by the regulators. It's kind of like a very different atmosphere right now. And Morgan Stanley, for example, in February was criticized in public by the CSRC about them not having the right business model because the overseas operation are subsidizing the local China operations too much. These sort of remarks, they are typically done in a public, in a private sort of like scenarios, but we are now seeing these comments sometimes from regulators like regularly, which is very interesting.
So, Kathy, it is very interesting. So if you're a global bank, you kind of think, right, well, China, you know, I have to be in China longer term because it's so much opportunities. Do I just comply, take the hit, and grind my teeth and not say anything? Or do you think you're going to see a pullout?
Yeah, I think it's too early to talk about pullout because everyone is pretty much thinking or reassessing the prospects there. They will not pull out because they are there really long haul, but they probably will have to readjust their strategies. Or not even strategy, probably we adjust the headcount. So you probably will be seeing people cutting, letting people go. At the same time, they will be more sort of like slowed down in terms of the hirings. And we actually have seen Credit Suisse is kind of delaying. There is a biggest bank project already for 2 years. And you will see more people gradually leaving China, but they will be there for the long haul.
Okay, Kathy Chen on today's Bloomberg Big Take, worth your time on the terminal and on Bloomberg.com. One of the challenges facing Wall Street banks, foreign banks, European banks in China.
That's it for the European market open. Plenty more market action as markets are really, it's one of those days where markets are really moving. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think the Fed's forecast from March saying that inflation would be coming down to the 2s by the end of the year was frankly delusional.
Today's inflation report confirmed what Americans already know. Putin's price hike is hitting America hard.
I think you've got to be very modest about what we know about this inflation process, and I fear that it's still going to get worse. We may well get to 9% at this rate.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Risk assets slump around the world as investors price in 175 basis points of Fed hikes by September. Two-year treasuries soar to a 15-year high. The yen extends losses against the dollar to reach a 24-year low. China also reverts to coronavirus curbs just weeks after it started to reopen major cities. Offshore Chinese stocks lead losses in Asia. Plus, cryptocurrencies crash land while Bitcoin slides for a 7th straight day to below $25,000. The picture is even worse for altcoins. Now let's check on the markets because it's a big market day with markets, frankly, all over the place. Certainly all the risk assets trying to find a floor or trying to find a comfortable position for a lot of the investors, depending on what Jay Powell does next. So you see European stocks down some 1.5%. There's a global sell-off that's deepening. I'm looking at stocks repricing, bonds, but also yen significantly slumping. So yen, you can see at 134.65. A lot of the move comes, of course, in the German 2-year and the Italian 2-year because the ECB is being tested by a lot of market participants, but it's also moving to the longer dated ones. You can see 153 for the German and the Italian at 3.84. Now, what is also extremely interesting is that you see Bitcoin under pressure now, maybe being used as a risk asset because we're seeing that fluctuation that is also getting pretty aggressive. NASDAQ futures pointing lower, the S&P pointing lower, and of course one of the things that we're looking at from a lot of the bank commentary is that the extended sell-off could push the S&P 500 back into a bear market. If you look at tech, over in Hong Kong, one of the biggest decliners, 5% lower as we're seeing more curbs in China. So everything is coming at a flux. It really started with that U.S. inflation print over on Friday. Jay Powell talking on Wednesday. Then we have the Bank of England on Thursday. It'll be interesting to see how Jay Powell, of course, does this. Overall, Bitcoin, again, 24,627. Now, U.S. inflation accelerated to a fresh 40-year high in May. It's an indication that price pressures are becoming entrenched in the economy and shattering consumer confidence. Our guests weighed in on data and its implications for Fed policy.
we see inflation continue to ripple through the economy and wreak havoc.
Certainly the drivers of inflation have broadened out.
Broadening and deepening out.
Everybody knows that inflation is going to be sticky.
Inflation is going to be stickier at a much higher level.
More clarity from the Fed is what's needed for the equity market to find its footing.
The Fed has more work to do.
More to do in the coming weeks and in the coming months.
Rates need to go significantly higher.
Beyond 3.5%.
Between 50 and 75 basis points.
Can the Fed pause in September? Well, we know that the answer to that now is no.
I don't think anybody thinks that we're going to get out of this without interest rates being significantly higher than they are right now.
Now, markets pricing in about 175 basis point hikes from the Fed by its September meeting. That includes at least one 75 basis point move, but even that might not be enough. That's according to our guest, Octavio Morenzi, this morning.
I fear we're drifting into a similar scenario here, where the Fed at some stage is going to have to really increase interest rates at a remarkable level, not just 75 basis points per meeting, like 100 basis points or more very, very regularly every single month to get inflation under control.
Now we're joined by Salman Ahmed, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, first of all, thank you for joining us, but it's a huge markets day. Or is there danger that actually we're pricing in things wrong, that central banks won't be too aggressive because they still worry about growth, or will they just focus on inflation?
Good morning, Francine. Certainly, I think a lot of forces in play, but I would like to call out some of the structural forces which we shouldn't forget, which is like there is a lot of debt in the system. And there is a limit to how much the key central banks can push policy without triggering a debt crisis. So we are already seeing some hints of that in the Eurozone with the periphery. This inflation, of course, is a huge problem. The Fed and the key central banks have underestimated these forces. But at the same time, those structural forces can start to kick in as well. So this idea that the Fed can go very fast and very strongly has its natural constraints when it comes to the very high debt ratios, and it can make things much worse than inflation can.
So what does it mean, Salman, where you want to be invested right now?
Right now, Francine, we remain cautious. We were looking at the relief rally, which happened with very skeptical eyes. We think that further tightening in financial conditions is needed, and that can be achieved by further communication to that effect rather than actual policy maneuvers. So credit market has been very, very resilient, isn't pricing in any kind of proper slowdown in economic growth. So that's where we are focused on. We are underweight credit, and we are cautious on equities. But at the same time, we are also looking at areas of the market which have been affected a lot in this sell-off. For example, in regions, we're looking at Japan.
But in Japan, so what would you be buying? I mean, can you go through the currency, or are you just sticking with certain stock picks?
It's more on the equity side. The currency depreciation is helping from a exporter-based basis, and it's also a leverage play somewhat on China reopening. Of course, news flow on that front has been very volatile as well. As you mentioned earlier, more reports of curbs, but there is a lot of pent-up demand, and credit easing is clearly now kicking in China, which will probably help with strong growth in the second half.
Salman, what's the biggest danger right now from central banks? I don't know whether now's the time to already start worrying that they hike too much and then have to cut in 2023 or 2024, or whether that's a problem further down the line once they get inflation under control.
I think to your former point, we generally think that if the Fed is able to execute what the market is pricing in, then the certainty of a recession is almost 100%. And that means that they will have to reverse course going forward. So it will be a very volatile cycle from a macro and policy perspective compared to what we have been used to in the last 20 years. So that's a new steady state regime, which is much more volatile from a macro perspective. So that's where the risk is, that they basically go too fast. We know the consumer is under a lot of pressure. We are seeing it in the UK that there is now 2 months of contraction. So UK seems to be a bit more advanced in this cycle. We also know from the Michigan surveys that consumer in the US is under a lot of pressure. So growth can fall off quite quickly in the next few months.
Salman, is there something right now that you think is being mispriced or misread by the markets? Do you think that 75 basis points from the Fed is really on the table?
I think there can be a potential talk for it, but we are not in the view that the Fed will notch it up to 75. There is a lot they can do with QT as well, with the pace and the calibration, and of course the general narrative of that. The Fed itself has gotten itself cornered because of the bad forecasting experience it had last year. But at the same time, as I earlier mentioned, there is a lot of debt in the system. We know this, the European Central Bank knows it. And if, for example, periphery blows up or some part of the big credit market blows up, then you have another issue to deal with rather than just inflation. So it's a very tight balancing rope because we have had so much monetary policy easing in the last many years.
So, and you're talking about this tight, balancing act. What's the danger of a policy mistake, and what does that look like?
So the policy mistake for us would look like is basically some kind of a significant liquidity accident in credit markets, and or in the Eurozone, a massive fragmentation in spread. So the financial doom loops, which we have forgotten about so far, start to play back, and that would be a massive policy mistake. And then the second point in terms of more macro cycle would be that the curve starts to steepen rapidly, and inflation expectations start to de-anchor. So far, the inflation expectations are quite anchored below 3%. So the Fed so far has been doing quite a good job in terms of making the market, at least the price market, aware that inflation is not on a runaway path, but that's something we are watching very, very carefully.
Salman, talk to me a little bit about periphery yields, and this is really where it's playing out. If you look at the difference between Italian and German yields, they just continue to widen. That spread widens. Are we in a danger zone where the ECB needs to show what they can do, otherwise markets will continue to test?
I think last week, Ms. Lagarde hinted at potential usage of existing and new tools if the fragmentation increases, but she was quite vague about it. We saw in March 2020, when the lockdowns happened, this doom loop started to take hold, and then the ECB threw the kitchen sink at it. So to our mind, there is a big risk that the market tests the ECB, and you may have a split between monetary policy tools, whereby the rates policy is used to tackle inflation, and you may have QE, even though it may not be called QE, but some kind of QE to make sure that the fragmentation remains contained. Because if these spreads blow up and debt sustainability questions come on the table, then we have bigger problems than inflation, which we'll have to tackle with. And one last point I would mention is that in a controlled environment, good inflation is good for the debt ratios.
Salman, thank you so much. We'll have plenty more from Salman Ahmed there from Fidelity International, who stays with us. Coming up, the weekend saw mass COVID testing and rising infections in China. Lockdown fears linger as it finds the latest COVID outbreak harder to control. So we'll have plenty more from China next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
A lot what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, China is starting to reimpose COVID restrictions just weeks after it started lifting them in key cities. That's raising concerns that the country may once again employ strict lockdowns to control its outbreak. Well, we're back with Salman Ahmed from Fidelity International. Salman, first of all, thank you so much for sticking with us. When you look at some of the China cases, when you look at supply chains and all of those concerns coming from China, how do you play thematically China right now?
So China for us has been more of a story of valuation. The macro, cyclical macro has been a lot of stress, as we know, because of the very harsh implementation of zero-COVID policy. But we have seen some of the lockdowns started to ease, and then the impact on reopening demand. And lastly, the policy stimulus, which was there was a lot of talk about it over the last several weeks, but now we are seeing that in data. So the valuation for us was pricing in a lot of severe negative growth outcomes. And we thought that as reopening comes through, that would be beneficial for China. But it is a very volatile market and remains one, so that's how we are thinking about it in terms of positioning, but it does benefit from very low valuations.
Does it change some overall, some of the supply chains and your conviction on emerging markets?
Overall, a number of emerging markets, because of commodity prices, especially energy and food prices, are under a lot of pressure. So the importers of energy, we think, are going to remain under pressure, because our view is that oil remains higher. And then, of course, the issues we are seeing in the food markets as a result of the Russia-Ukraine war. So there is this split between commodity exporters and importers we are trying to focus on. That's why we like LATAM, less so of parts of Asia, which are massive commodity importers.
Is there anything in Latin America that actually you like more than others? And again, I guess it's a difference if you're an oil exporting or importing country.
Oil exporting, importing is obviously a key differential. Of course, we are also focused on some of the industrial exporters or exporter of industrial commodities. There's a structural capex shortage in that area. And of course, with the decarbonization themes, they may benefit from a terms of trade perspective. That's something it's a more longer term play for us, because obviously there is a concern about growth slowdown here. But from a more structural perspective, there's a massive supply shortage, which we are trying to focus on countries like Brazil, Argentina on the agriculture side, which we think have valuation support.
Salman, we keep on talking about this exodus in certain shares. So we're talking about a repricing in a lot of yields across the world. Do you worry about liquidity in the markets?
Certainly, Francine, this is something which we have been very difficult to forecast. And when it happens, it appears very obvious that why has it happened. But timing it becomes very, very difficult. But these are the kind of situations where there is stress in the system, which can trigger these structural weaknesses, especially in fixed income markets, because of the very high regulation which came after 2008, 2009. So that's something which we are watching for signs very carefully. So the various spreads like FRA, OIS, or signs of stress in cross-currency basis. That's something which we are watching very, very carefully, because they only make themselves visible once a big accident has happened. And this is the kind of environment which accident can happen.
Salman, what kind? I mean, again, is there a trigger point, or how do you see the accident before it happens to be able to change your portfolios around?
So, the QT start would be an important trigger for us, i.e. how does the market absorb, excuse me, the withdrawal of actual liquidity. In the Eurozone, we know that after the QE shuts down, there's going to be a hole of around 7 billion euros in the corporate credit market. This was a big buyer, ECB was a big buyer of corporate credit, and that's a big hole to fill. especially in an environment where rates are going up and the central banks are becoming generalized very hawkish. So those are the trigger points, and then those are specific credit markets which we are concerned about. So another added reason why we are cautious on credit.
Salman, smart as always. Thank you so much. To the point. And of course, always interesting. Salman Ahmed, their global head of macro and strategic asset allocation at Fidelity International. Now, let's get straight to the Bloomberg First Word News. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. China has issued one of its strongest warnings yet about the risk of war over Taiwan. Speaking at the Shangri-La Dialogue in Singapore, Defense Minister Wei Fenghe repeatedly expressed Beijing's will to fight a formal split by Taipei. Bloomberg has also learned that Chinese military officials are disrupting Washington's stance on the Taiwan Strait, telling their U.S. counterparts in meetings that it is not international waters.
To us, the strategy is an attempt to build an exclusive small group in the name of a free and open Indo-Pacific, to hijack countries in our region and target one specific country. It is a strategy to create conflict and confrontation, to contain and encircle others.
European Commission President Ursula von der Leyen says the body's upcoming opinion on Ukraine's push to join the EU will carefully consider the progress the country has made over the past decade. Von der Leyen's trip to Kyiv on Saturday was her second since Russia's invasion. She expressed her solidarity with Ukrainian President Vladimir Zelensky. And U.S. senators have reached a tentative deal on a new gun safety legislation package. It includes giving grants to states to implement a red flag laws, allowing courts to remove guns from potentially dangerous owners, and more funding for mental health services and school safety. Although negotiators must still agree on details, the agreement is a significant breakthrough after years of little progress. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Angel, thank you so much. Angel Feliciano there with the very latest in First Word. Now, first, we're looking at the markets. We continue looking at the markets as there's a massive exodus amongst stocks. This is not filtering only through from Asia, but really impacting how the U.S. will open. Fed rate hike now of 75 basis points seemed to be a done deal when you look at traders and how they're pricing it in the markets. Now, coming up, crypto takes a beating as the latest U.S. inflation data sours market sentiment. We discuss that next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, Bitcoin has plunged to an 18-month low amid a broad sell-off hitting the cryptocurrency. This is in line with the ugly start to the week for risk assets. Now, for more on this is our crypto czar, Joanna Ossinger. Joanna, first of all, what exactly is happening with Bitcoin prices?
Hey, Francine. So it is just a multitude of things happening. First of all, Bitcoin was really in a range around 30,000 for a few months. It was getting pretty comfortable there, but it's dropped out of that range below it now as we have the Fed hiking rates. We have concerns of even faster rate hikes. We have inflation running hot. And then on top of that, when we had the Terra Luna implosion last month, and now we have Celsius, a big crypto lender that's frozen withdrawals, you have even more concern about what's going on in the space. So it really is a number of things fueling a kind of an accelerated drop here.
So what's going on, broader term, Joanna? How do they find a floor, if at all? Is it tracking anything?
Well, there are some suggestions that it could find a floor around its 200-week moving average, which is about 22,000, possibly even around 19,500, which was the 2017 high. But it is definitely correlated with risk assets like U.S. stocks, for instance. And so it actually might be a leading indicator of U.S. stocks later, we'll see. But it definitely works along with U.S. stocks and those kind of big tech names and the riskier assets.
Joanna, thank you so much. Joanna Ossinger there with the very latest on Bitcoin. Our crypto czar. Now coming up, it's a gloomy start to the week, I'll say. Investors' sentiment really hurts. A lot of asset classes moving to try and understand how they reprice the Fed rate hike now of a 75 basis points really being priced into the markets. That's according to money markets. We continue our markets conversation, focus on commodities also with our MLive survey for the week. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Risk assets slump around the world as investors price in 175 basis points of Fed hikes by September. Two-year treasuries soar to a 15-year high. The yen extends losses against the dollar to reach a 24-year low. China reverts to coronavirus curves just weeks after it started to reopen major cities. The Hang Seng and the Nikkei both closed more than 3% down. Plus, cryptocurrencies crash land. Bitcoin slides for a 7th straight day to below $25,000. The picture is even worse for altcoins. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I mean, I say good morning, but actually, if you're working in the markets, it's probably a stressful morning. I'm Francine Lacqua here in London. Now, the war and pandemic-fueled shortage of raw materials is set to drive what's already the biggest surge in commodity prices in decades. That's according to the latest MLive Pulse survey conducted last week.
Commodities are very likely to remain supported because demand is still strong.
Best probably still oil.
Our combined exports of crude oil and petroleum products in recent weeks have been at the 10.5 million barrel a day range. That would make the U.S. the largest liquids provider in the world, bigger than Russia, bigger than Saudi Arabia.
We think that actually at the longer end of the curve in oil, we think is where the opportunity is. At the short dated contracts up above 120.
You look at oil at 120. Doesn't seem that expensive.
Of course, we have everything which is related to food, so anything which is corn and wheat.
Wheat is in short supply.
And that's mostly because all the geopolitical tensions that we're seeing with respect to Ukraine.
We're planning for continued inflation for the foreseeable future.
The combination of the war and the supply and demand imbalances that were already in place before the war began, especially in energy, will really push up ag, base metals, precious metals and energy together.
We're looking at the likes of nickel especially and lithium. They're the two commodities that we think will do very well over the course of this year.
We expect industrial metals to eventually have a bounce back towards the latter half of 2022 as well, given the fact that now we're seeing a rebound in China.
At this stage, we've got a good call for gold, but we don't think that it's going to be the best performer over the rest of this year.
The pressure is going to continue. We are not at the peak yet.
Well, joining us now is Eddie van der Walt from our Markets Live team and Diana Moa, Chief Investment Officer at US-based hedge fund Kirkoswald. So thank you for joining us. So exciting having you in London, Diana. But first of all, Eddie, we had this MLive survey, which is basically what you do with commodities and things like that. I mean, it's not surprising, but people are very worried about the price of raw materials.
You know what? I'm a little bit surprised by just how bullish the market is broadly on commodity prices. I mean, we have seen the supply chain shocks come off a little bit. When we look at those CPI numbers, what we've seen is that it's much more about services than it is about goods at the moment. But still, when we ask our readers what they think, they say they worry about commodities. What they worry about most of all is things like wheat. I think the commodity story is one that you have to break down into its sub-baskets at the moment. I think oil has already gone a long, long way. And of course, that has implications for, wider markets.
Yeah, it has huge implications, especially for the emerging markets, which is your specialty, Diana.
Indeed. And it's interesting because what we're seeing is for emerging markets, food and fuel are the two things you have to watch. We don't think the soft commodity pressures are right behind us, because if you take a step back, everyone focuses on Russia, Ukraine as the big driver. But when you look at food prices, they are up almost 60% from pre-COVID levels. This year, up another 13%. So this pressure on food prices had started well before the Russia-Ukraine invasion because of weather patterns and a shortage in labor markets. We also have we have headwinds coming through from fertilizer prices as well, which actually infer that the pressure from a food price angle is not going away. And fuel as well is the other big one. As much as we might want to see a ramp up in oil production, the issue is actually with the refinery capacity. That you can ramp up all you want, but if refineries can't actually work with that extended production, then it's not really going to move the dial. Yeah. And that's the conundrum policymakers face, Francine. When you talk about EM inflation, for instance, we've seen this narrative play out already for 2 years. And even despite aggressive hikes, we're still not at the peak of inflation yet. So this conversation that's happening today is very important.
Yeah, and then we'll see what the Fed does, which is what, everything that's happening in the markets, including emerging markets, but it's really, filtering through Bitcoin. You have this exodus, massive exodus in stocks. Is basically markets are now, traders are pricing in 75 basis point hike from the Fed.
Yeah, I think, you know what, I think one of the best things over the last few weeks is that we finally discovered a use for Bitcoin, right? We've discovered that Bitcoin is a fantastic measure of risk appetite over the weekend. And it's showing us, where the markets are going to open, and it shows us that the market is still.
So is yen, though.
Yeah, but that is true. That is true. That is true. It's not alone in that space. It's a substitute for a couple of other, But here's, I think the market is very worried about 75 basis points. The market is worried that the Fed is going to come at them aggressively. The market's a little bit worried that there's going to be a policy mistake here, that they're going to kill off demand just as demand, remains strong. At the moment, they worry that this is not going to be the case. They're going to squeeze things like house prices. So, this is a very big conversation. And of course, it does matter for EM and all markets in general.
So, Diana, again, if the Fed hikes by 75 basis points, I don't know whether that's your base, so you have to change, a call on that. What does that mean for certain emerging markets?
Well, let's just take a step back. We absolutely think they should hike by 75 basis points. They need to stop talking inflation and start acting and getting ahead of the curve. We've seen this story in emerging markets. Once you lose credibility as a policymaker, you have to do a lot more work later down the line, and that's what tips you into a recession. So they should have 75 basis points at this meeting. Whether or not they will is a big question mark, but them not moving quickly to act, I think, is going to be a policy mistake that impacts risk assets globally. Because if the largest central bank in the world is perceived to be losing their handle on inflation, it has ramifications for EMs and for other developed markets. So everyone has to do a lot more work.
But Eddie, so why were they shy? And we heard it from Jay Powell, actually. He almost took 75 basis points off the table. Why were they so shy in dealing so aggressively? Is it, if they hike 75 basis points, does it mean that actually they can't engineer a soft landing? And also the 210 are inverted now.
Maybe, because I think we are seeing a little bit of pressure coming through on the consumer, right? And I think the Fed doesn't want to go faster than they absolutely have to. And we have seen prior to the most recent reading, we saw inflation coming back a little bit. And they were saying, okay, well, let's wait and see. But I think, I think Diane is right. The time for wait and see is over. It's time for show and tell now. And, I think the Fed needs to convince the markets that they are serious, but similarly so the ECB, and they are the ones that are furthest behind the curve here.
So 75 basis point hikes is what you're calling for, Diana. What does that mean for dollar? And again, what does it mean for the emerging markets that you like?
So emerging markets came into this year already having gone quite far along in terms of their hiking cycles. So they are a lot more resilient than they would have been if they'd have been caught asleep on the wheel of inflation, similar to what we're seeing with some of the developed market policymakers. So in that extent, there is a little bit of a buffer built in. That said, when you have 10, 15 basis points moves a day in US Treasuries, it impacts all risk assets. And so we're seeing this broader repricing of global yields that, unfortunately, even despite doing all the heavy lifting of hiking proactively, EMs simply can't decouple from that. And so we're still concerned about risk assets. It's been our stance from the start of the year that we think until we get a handle on where inflation is going to be, how much the Fed needs to do to get inflation expectations anchored again, and what the impact of quantitative tightening is likely to be. It's very hard to be necessarily overly optimistic on the prospect for risk assets here.
Yeah, could I just say also, Eddie, we were just getting the 210 inverted, which I maybe mentioned too quickly without spending too much time. I have a viewer, Anthony, thank you. He always writes in and he says we're worrying too much about the ECB and actually the divergence in some of the spreads there, for example, between Germany and Italy, and not focusing on the US and the 210s. What does it mean?
Yeah, absolutely. You know what? I think the market is pricing an aggressive Fed at the moment, this moment in time. I don't think the market is necessarily pricing any sort of a hard landing just yet. If the yield curve in the US is correct and it's telling us something about a recession that's coming along, then I think that this market and stocks in particular have a very long way to go to really pricing, the downside that is possible. And that will feed through into EM, that will feed through into global markets, everywhere. I don't think there's anybody that can escape a US hard landing. But we're not pricing that yet. At the moment, all we are pricing is that aggressive Fed coming at us.
All right, both of you, thank you so much. Diana Moa, their Chief Investment Officer at Kirkoswald, Eddie van der Veld from our MLive team. Follow our live coverage of markets at MLive, and actually both are staying with us as we continue looking at the markets that are really, really moving. The US 10-year, of course, inverting just moments ago for the first time since April. Coming up later, as London Fashion Week draws to a close, we'll also be joined by Caroline Rush, the Chief Executive of the British Fashion Council. We talk about green, we talk about Brexit, we talk about inflation. It's also the 10th anniversary of the June showcase, and the challenges facing the industry are not minimal. We'll talk about that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we stay on the markets. The market's moving quite deeply. If you look at the U.S. 2- and 10-year curve actually inverting for the first time since April. Now, that signals, of course, signs of an impending recession. There's also huge repricing with a Fed rate hike of 75 basis points. Now, pretty much a done deal for money markets for traders. Now, joining us back is Eddie van der Veld from our Markets Live team and Diana Moa, Chief Investment Officer at U.S.-based analyst, hedge fund at Kirk Oswald. So thank you both for staying with us. First of all, Morgan Stanley very kindly just dropped a note in my inbox that basically says, look, the growth risks are still not priced into the markets. What are the markets pricing in?
Yeah, absolutely. I completely agree with them. I think what the market is pricing in right now is a very aggressive Fed. The market is not really there at that point where they're saying, listen, we're heading for any sort of hard landing. The way I can tell that is when I look at when I see data releases coming in, we are looking at a situation where good news is bad news at the moment, right? Where hot readings are seen as fueling a Fed narrative rather than telling us a story about the market sentiment overall and the prospects for growth. And I think that shows us that the reaction function in the markets at the moment is entirely geared to what the Fed is going to do, not to what the economy is going to do.
And are you expecting some kind of synchronized slowdown globally?
A slowdown, but not necessarily a recession, particularly from a U.S. perspective. When you look at the starting point of this hiking cycle, we don't tend to see the kind of excesses that you've seen, whether it's balance sheets for corporates or consumer balance sheets. So although sentiment was weak, consumer sentiment was weak in the survey on Friday, what's actually different is when you look at the spending behavior, we're not seeing that filtering through yet. So durable goods spending has come down, but services spending is still going up. When you look at the median consumer checking account, it's higher than it was coming into COVID. And so overall, I think the consumers are in a strong place, and businesses have been proactive in trying to deal with these inflationary pressures. So we might see a slowdown further down the line, but unless the Fed really falls behind the curve and is forced to be much more aggressive than markets are expecting, I think it's more of a slowdown rather than a recession.
Yeah, so, I mean, the Wednesday is a huge day. I mean, it was always a huge day for the FOMC, but actually Jay Powell has to walk that line of, you know, how does he see inflation? So how he describes it and characterizes will be really watched out for, and the Fed funds targets.
Absolutely. And, you know, the Q&A is always really interesting because they're always put slightly on the back foot by what they've said before, and, you know, they've been thinking for 2 days straight. It's hard not to make some sort of a gaffe in those situations. Powell's obviously, he's a master in these situations. He can, you know, tell the market exactly what the market needs to hear, or at least what he wants the markets to hear. But, you know, this is probably one of the most important statements that we're going to get from the Fed in a long, long time, because it is hard. It is hard to pull back as hard as you need to on the economy right now without engineering a hard landing. I hope Diane is right.
Yeah.
I think it's going to be a difficult trick to pull off.
Eddie, I have a question for you, a viewer question. Please write in as much as you want, as much as you can, actually. We love listening and hearing what you have to say. So this person writes in, Eddie, for you, does Eddie believe that the VIX is underpriced, and where do you believe market angst fair value should be?
Oh my goodness, that's a hard one. I mean, the VIX is. The VIX is a creature of its own habits. I think that the VIX is probably a little bit low given the uncertainty broadly that we have in markets. I think we're probably going to see volatility increase. I think we generally see volatility increase as liquidity is drained out of the system. Right? This is just a normal functioning. It's a normal functioning of markets. So I think, you know, the VIX. We are in a higher volatility regime now. You know, Cam on the blog regularly writes about you know, this higher regime that we're in. I think it probably remains with us. It probably gets worse before it gets better.
And Diana, I guess, you know, there's QT, this broader hiking cycle, capital preservation is what you point to being critical. And then we haven't really touched on China, which could be one of the catalysts also putting pressure on these markets.
Exactly. So there's QT, there's the anchored sense of where rates need to be globally, aggressive hiking, inflation. There's a lot of headwinds, which mean that until markets can form a consensus, and we can't form a consensus if the Fed doesn't necessarily know where they're going, volatility is the name of the game, as Eddie is saying. I think for the next few months, one needs to be careful of engaging too soon in risk assets. I do hear the argument that there's value in certain parts of the market, but we still don't see enough value in some of the big markets. So we still have a preference for being underweight fixed income, short duration, and we actually were fairly cautious on the outlook for credit markets in the short term. As far as China goes, you know, China reopening is going to have speed bumps, right? Yeah. We're seeing that with the news over the weekend. But ultimately, when China fully does reopen, you'll have more demand coming in for things like fuel. So that's going to be an additional inflationary catalyst. That means you can't really call a top on where rates are heading or how price action evolves.
Diana, thank you so much. Diana Moore, their Chief Investment Officer at Kirk Oswald, and Eddie van der Wald from our MLive team. Now follow our live coverage of markets at MLIV Go. Coming up, as London Fashion Week draws to a close, we'll be joined by Caroline Rush, the Chief Executive of the British Fashion Council. We'll discuss the 10th anniversary of the June showcase, but we'll really focus on the challenges facing the industry, including labor shortage and inflation. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Just a quick look at some of the bond headlines, because it is maybe not a bloodbath, but certainly huge moves. Short German bonds actually extending their slide with the 2-year yield rising 10 basis points. Now, on to London Fashion Week, and it's drawing to a close today, as the British Fashion Council also celebrates the 10th anniversary of the June event. Now, while it was traditionally an event exclusively for menswear collections, it has since evolved to support fashion that eliminates gender constructs. Now, we're joined by Caroline Rush, the Chief Executive of the British Fashion Council. Caroline, as always, thank you so much for coming on. There's so much that actually luxury and fashion can give to this country in terms of GDP, in terms of, spending and consumer spending. But what's your main challenge right now?
Well, there are so many challenges, of course, particularly for the high street, but also for the designers and businesses that are part of London Fashion Week, that are showcasing collections that are sold all over the world. And, of course, the big challenge for them when they're looking at that export opportunity is really the tariffs that are now in place post us exiting the EU.
Is there any talk about getting rid of those? So, I talk about the markets day in, day out. You're living this, right, through your designers. It's also inflation, it's labor shortages, it's tariffs.
It is, and then we have the added challenge, of course, for our, we're fantastic post-COVID is that welcoming back the travellers to the UK, but we're seeing that spend that would normally happen within UK retail happening in Italy, happening in France, because of course those luxury good customers can't claim back the VAT, and they are price sensitive. So we do need some levers to help support our industry and to really think about sort of bolstering the future of not just big businesses and big retail, but the micro businesses across the UK.
Are there any conversations with the government that actually this is something, I mean, again, a lot of the designers have to contend with higher prices in what they make. I don't know how much of that they can pass on to the consumer and whether Number 10 is looking at all of that.
Well, of course, is that we know that consumers are price sensitive, is that everybody will be looking to see how they can try and manage prices. But of course, inflation will have a knock-on effect eventually. And any support from government, of course, being able to look at tariffs is something we want them to do, but it has to be reciprocal because, of course, is that we want to make sure that we're on a level playing field with our European counterparts.
I mean, shipping costs are also going up. Is it something, like, what are the top three concerns, I guess, apart from tariffs that your members are worried about?
Well, they're very concerned about shipping. Again, as the cost went up as we exited the EU, as the shipping costs have really gone through the roof. And we know, of course, because of the rising prices in fuel, that is just going to continue. So that is a real consideration. Fashion is a component part business. You know, we have bits coming from all over the world that come together to create the clothes that we make. And that is a real concern.
What are you most excited about? So without, you know, I know it's not all doom and gloom.
Really
I guess the Jubilee also gave a resurgent, or, you know,
it was
kind of
fantastic.
put British at the forefront.
It did. It put the UK at the forefront. Is that it was fantastic to see, of course, in the UK, the consumers out over the bank holiday. That saw a boost to sales, which was brilliant. I think internationally, of course, for London Fashion Week, all eyes are, of course, on the UK at the moment. So it's great for our brilliant creative businesses. And we really hope that that export opportunity will be lived out over the next few weeks as we see, hopefully, their sales soar.
Caroline, what are some of the companies that, I don't know if there's a type of fashion luxury company that can actually pass on some of the higher prices to their customers?
Well, we've already seen some of the luxury good prices go up over the last year or so. So we know that there is an opportunity to do that. Many of the businesses that are part of London Fashion Week really are small businesses, the ones that are mostly impacted with all of the rising costs. They don't have the buying power to negotiate. And so, unfortunately, that is where they'll have to look at passing on some of those costs to the consumers. We'll be working very closely with them, of course, to look at how they do that.
Caroline, thanks so much. As always, a little bit of much-needed glamour in this gloomy bond and stocks market. Caroline Rush there, the Chief Executive of the British Fashion Council. Now, let's get back to the markets because equity and bond moves are steadily getting uglier out there. European trading day, of course, is wearing on. I'm looking at some of the calls or talks on another S&P 500 bear market abound. Traders now pricing in a 75 basis point Fed rate hike. The Stock 600 also extending some of the declines here in Europe, down more than 2%. Now, when you look at tech, it's definitely leading the losses as declines or as bond yields are rising. Cyclical sectors such as auto and consumer products lagging as the recession risks rises. So I don't know where we end up in a couple of hours from now, but certainly there's a bond bloodbath, as our Valerie is putting it. More Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kaylee Lyons in New York. Our Anna Edwards is in London. We continue looking at the markets. Also, the risk of more commodity inflation beckons as there's more demand for coal now because of the war in Ukraine. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is an inflationary process that has been broadening and deepening out.
The risks of eventual recession are rising.
It's a clear signal from the Fed. We're going up and we're going fast.
I think it's important to realize that we got a lot of emotion here in this market.
The Fed's forecast from March saying that inflation would be coming down to the 2s by the end of the year was frankly delusional.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, June 13th. Our top stories today. Sea of red, global stocks plunge and bond yields surge following Friday's shock U.S. inflation print. Investors now pricing in 175 basis points of Fed hikes by September. Over in Asia, the yen sinks to a 24-year low as the Bank of Japan's governor delivers his clearest warning yet that a rapid slide in the currency is damaging the economy. And crypto crumbles. Bitcoin joins the broader sell-off, sliding below $25,000. The lender Celsius freezes withdrawals, further eroding confidence in the crypto space. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and with Kaylee Lines over in New York. And Kaylee, we're still really dealing with the after effects, the aftermath of that inflation print on Friday in the United States. We're back to talking about more interest rate hikes and the impact that that's having on other asset classes, a stronger dollar, for example.
Yeah, you maybe want to buy the dollar today, Anna, but investors don't seem to want to buy literally anything else. It is absolutely brutal out there. And really the best way to illustrate it is with the GMM function on the Bloomberg terminal, which shows just how bad the picture is across asset classes. That was certainly the case in the Asian session, where pretty much equity benchmarks were lower across the board, including in South Korea, where the Kospi was down about 3.5%. The Nikkei was down about 3%. In Japan, stocks were down in China and Hong Kong as well. And of course, that continues to be story with COVID-19 as you're seeing restrictions going back into place in areas like Shanghai. Then in foreign exchange, pretty much every Asian currency is weaker against the dollar. Interestingly, the yen is now the one exception, just fractional strength, which I'll come to in just a moment. And of course, you're seeing that selling pressure in the global bond markets. On the GMM function, you have multiple black boxes for bonds in places like Singapore, for example. So multiple standard deviation moves happening. And in Japan, even, you have that 10-year JGB yield back above 25 basis points, which of course is the BOJ's target. To come back to the Japanese yen, though, specifically, it has started to strengthen a little bit as the session has grown older. But at one point, we were north of 135 on dollar yen. That is the weakest level going all the way back to October of 1998. It is that rate differential story, Matt. The BOJ wants to stay easy. The Fed, though, on a tightening path, and the market thinks they're going to be even more aggressive in the wake of Friday's inflation data.
Yeah, absolutely. It is brutal for risk assets today. We see S&P futures down 2.5%. This after the nearly 3% drop that we saw in the cash trade on Friday. That followed a 2% drop on Thursday. So risk assets come tumbling down. Investors are also selling off bonds. So the 10-year yield rising right now 322.70, but we've been as high as 324 and change. So we're approaching really 325 here, approaching 2011 levels on a 10-year yield. NYMEX crude coming down a little bit on news out of China, COVID, and the negative news there, pushing the Texas Intermediate price down to 118.72. And Bitcoin. This is, Kaylee, we've been talking for days about whether or not I should just take this out of the board because we're not moving out of the $30,000 range. Well, today's the day. 24,100 right now for Bitcoin, far off of the level where most retail investors would have gone in to buy. It looks like that model may be broken. Now we're looking for the next level. Anna?
Yeah, we'll get some more analysis on the crypto space later on in the hour, won't we, Matt? Let's bring things back to where we are here in Europe. Across European equity markets, another sea of red. So Kaylee was standing in front of that GMM screen, illustrating the Asia picture, very negative, selling everything apart from the dollar, it seems. Well, here in Europe, we're selling stocks, and you can see that very clearly reflected here. We're down by more than 2% in some of the major markets here in Europe, the French market, the German market, the Italian market. And remember, during Friday's session, we did price in some of the response to the US inflation print. We were down by more than 5% on the Italian market, down more than 3% on some of the other major markets here in Europe on Friday. So a continuation of some of those vibes coming through from Friday as we continue to price in more and more hikes from the Federal Reserve and also, incidentally, from the ECB as well. Let's have a look at where some of the damage is really being felt today. And we see that the tech sector is really under pressure. So just as we see NASDAQ futures down more than some of the other major markets over in the US, just here in Europe, we see technology under pressure. Atos is one of the reasons for that. This is a technology company based over in France, and some of the changes that they have decided not to do, some of the assets they've decided to keep hold of, going down negatively with investors, and one particular broker saying this is a bad decision. The stock down by just over 11%. Back to the macro picture, and Italy 2-year yields really in focus. It's the short end of the curve, whether you look at the US or whether you look at Europe, where we do seem to be seeing a lot of that adjustment, that bear flattening move that has a lot of people asking about stagflation and what the markets are trying to signal on that front. We're seeing some big movement here. We were down below 1.2% on the Italian 2-year before the ECB meeting. We're now at 1.9%. So increasingly, the market asking about fragmentation across the Eurozone and what the ECB can do, what tools it has at its disposal to try to stop that from happening. We see those yields on the rise. Go Ahead Group, another corporate I wanted to just briefly mention, Kaylee, because this taps into some of the other trends we've been seeing around weakness in the pound and how in play UK assets are as a result. This is a bus company, and we see a number of bidders lining up for this one, apparently, and the stock is up this morning by 21%, Kaylee.
All right, Hannah, so a lot going on already, and it is only Monday morning, so gear up for a busy week ahead. As for what we can expect in the coming days, on Tuesday, we'll be speaking to Hong Kong's outgoing Chief Executive Carrie Lam in a sit-down interview, so don't miss that on Bloomberg Television. Also on Tuesday, UK Prime Minister Boris Johnson may speak alongside Chancellor Rishi Sunak to lay out the government's economic vision. How are they going to deal more with the cost of living crisis? We'll, of course, get that Fed rate decision on Wednesday. What, if anything, do they say about 75 basis points? Then the Bank of England will follow with its rate decision on Thursday. And finally, the Super Return Conference takes place in Berlin, a major event for the big names in private capital. And Bloomberg's Danny Berger will be on the ground speaking with Carlyle, KKR, Apollo, and more, Matt.
All right, we'll be watching that very closely. Now, though, back to the market drops that we're looking at. The global exodus from stocks and bonds intensifying as investors grow increasingly concerned that inflation will force central banks to squash economic growth with higher interest rates. Bloomberg's Danny Berger has more on today's market action. Danny?
Yeah, the market continues to get decimated by these inflation fears. Started Friday, of course, after that 40-year high in the inflationary reading. But what's really changed today is this ramp up in bets that the central bank, that the Fed is going to have to get very aggressive. We've seen both Barclays and Jefferies after that inflation figure saying 75 basis points is what they expect in June. Barclays writing the U.S. central bank now has good reason to surprise markets by hiking more aggressively than expected in June. So now the market is starting to catch up. 175 basis points priced in by September. That would imply 75 basis points at some point. You do see pricing starting to look 50-50 there when it comes to the July meeting. So all of that means a major readjustment and a painful readjustment in markets. Two-year yields, those are up at the highest since 2007. 2s, 10s, that curve has inverted just moments ago. Your two-year yield in Germany above 1% for the first time since 2011. And the periphery, Anna, you were explaining this, getting slammed as well. This is the third day in a row of moves in Italian BTPs in the two-year at least of more than 20 basis points. The spread between these two, the superlatives, I know they're endless here, the spread between these two, the widest since 2020. And of course, the 10-year yield in Japan moving above that 25 basis point upper bound set by the government. So it's a global bond market, and that hitting equities as well at the moment. Futures indicate that the U.S. is set to open up into a bear market, Anna.
Okay, so Danny, it's a gloomy picture when it comes to risk assets this morning. And sticking with risk assets, crypto lender Celsius paused withdrawals, swaps and transfers on its platform, fueling a broader sell-off in that space. And Matt's been through the action we've seen on Bitcoin. What's the latest?
Yeah, that Celsius pausing of lending and services really just adding fuel to the fire. It's this idea, Anna, that this froth in the market, it no longer will be supported if the Fed is going to get aggressive, if they're drawing liquidity from the system. So Matt showed Bitcoin down 12% now, Ether 20, the Bloomberg Galaxy Crypto Index, that down 5.6%. We saw it with Terra before, concerns of just corners of the market breaking. Is this bigger than a quarter? Is it something that is going to break the system with the Fed? As Barclays says, they think they're going to move 75 basis points on Wednesday.
All right, we'll see what happens. 2 days to go until that decision. Bloomberg's Danny Berger, thank you so much. Now let's get back to the Japanese yen, which fell to its lowest level since 1998, prompting warnings from the Bank of Japan as its easing monetary policy increasingly feels the strain of rising interest rates elsewhere around the world. Joining us now for more is Enda Curran, our chief Asia economics correspondent. So Enda, Kuroda's starting to get worried about the Japanese yen here. Is it likely that Bank of Japan policy is going to change?
Well, he made clear that the yen's weakness is certainly a negative for the economy. He made it clear that it makes it difficult for businesses to plan. And he said that the Bank of Japan will work with the government to try and offset the impact of the yen slump. Now, as you say, though, it's not necessarily clear what the Bank of Japan can do in response. They do have a policy meeting this week. Some economists are saying they may use that meeting to tweak some of their toolkit in response to the yen's weakness. But I think the overall view among markets is that the yen's weakness is being driven by this big divergence with the Fed, and there's little the BOJ can do about that in the near term.
Yeah, and elsewhere in Asia then, a lot of focus on a sell-off in commodities linked to the latest news lines coming out of China, walking back some of the virus loosening measures that we'd seen them bringing forward previously. So things getting tough on the COVID front once again.
It is getting tough again, Anna, and it does seem to be a backward step. Remember, in both Beijing and Shanghai, we had been hearing about restrictions being eased in recent days as cases there collapsed. Well, we've had a tick-up in cases again, in particular a cluster at a bar in Beijing. That's prompted the authorities to keep schools closed there and implement more mass testing. Likewise, in Shanghai, dine-in at restaurants has been banned in some areas. So it all speaks to the idea that China is sticking to its COVID-0 approach. But of course, COVID-0 is now having an outsized impact on the economy, and economists again warn today, given how transmissive the Omicron variant is, the ongoing policy response is posing a real threat to the economy through the second half of the year.
All right, Enda, thanks very much for joining us. Bloomberg's chief Asia economics correspondent, Enda Curran, there talking to us about what's going on in China. In terms of the military, China has issued one of its strongest warnings yet over the risk of a war in Taiwan. Speaking at the Shangri-La dialogue in Singapore yesterday, China's defense minister repeatedly expressed Beijing's will to fight a formal split by Taiwan.
If anyone dares to secede Taiwan from China, we will not hesitate to fight. We will fight at all costs, and we will fight to the very end. This is the only choice for China.
Joe Matthew joins us now, Bloomberg's Washington correspondent, for more on U.S.-Taiwan relations, U.S.-China relations. Joe, I mean, even though we sort of knew this, it was unspoken until now, this red line.
Yeah, they've been talking a little bit more about it lately, though, Matt. It's interesting to watch the rhetoric heat up here, and indeed, some of the most full-throated remarks here that China would fight, and it follows remarks from Defense Secretary, U.S. Defense Secretary Lloyd Austin just a day earlier talking about America's Indo-Pacific strategy, saying, quote, the stakes are especially stark in the Taiwan Strait. By the way, those two met in person just a couple days earlier on Friday, with Minister Wei saying China will not hesitate, as you heard, to fight to keep Taiwan a part of China. But this rhetoric is frankly nothing new in a decades-long standoff here. Lately, though, we've been hearing a lot more about it, Matt, against the backdrop of the war in Ukraine.
Meanwhile, on the domestic front, Joe, of course, we've seen a number of mass shootings recently here in the U.S. And in the wake of those and following the March for Our Lives protests in Washington over the weekend, we now have a deal, a bipartisan deal on gun legislation. What can you tell us?
It's a few weeks in the making here. As we told you, Democratic Senator Chris Murphy of Connecticut was talking with John Cornyn, the Republican from Texas, following the shootings in Uvalde, and they have, in fact, generated a deal here. We do not have a bill, we do not have legislation, but 10 Republicans have signed on to what is essentially a handshake deal here with red flag incentives, more comprehensive background checks for gun buyers under 21, even closing the so-called boyfriend loophole, which includes restraining orders and those who've been convicted of domestic violence. This is something that will likely come to light in the next couple of days in terms of details. Chuck Schumer, the majority leader, says he wants to get a vote on this as soon as possible. The president says he's prepared to sign it.
Joe, thanks very much. Thanks to Bloomberg's Joe Matthew. You can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Sticking with politics, let's get to France. Polling suggests President Emmanuel Macron may lose his outright majority in Parliament, forcing him to compromise to push forward reforms ahead of the next round of voting. Joining us now is Bloomberg's Caroline Conan in Paris. And Caroline, it was a bad night then, I guess, for Emmanuel Macron. He has only a week now to convince the electorate if he wants to hold on to that majority.
Not the best night for Emmanuel Macron, definitely, Anna. Unlike the presidential elections, the threat this time is not coming from the far right of Marine Le Pen, but the far left of Jean-Luc Mélenchon. Mélenchon's party, the NUPES and his allies, actually are neck and neck with Macron's party at around 25% in this first round. They will face each other in local ballots next Sunday, and Macron could actually be short of the 289 seats he needs to secure majority in Parliament. Mélenchon from the far left has been campaigning on anti-inflation measures. He wants, for example, to increase the minimum wage, to also cap all essential products prices, and to lower the retirement age to 60 years old, which is the exact opposite view to Emmanuel Macron, who wants to increase the retirement age in order to finance his other reforms. The most likely outcome, however, due to this two-round system in France, is that Macron gets a relative majority next Sunday and is forced to build some fragile alliance with the Republicans and fight on every single bill and reform.
All right, Bloomberg's Caroline Conan in Paris, thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. No surprise given the big declines we are seeing in the crypto space. That is translating into crypto-related equities in pre-market trading. Huge downdrafts for the likes of MicroStrategy, Marathon Digital, Riot Blockchain, Coinbase. They're all down at least 12%, 17% in the case of MicroStrategy. The other stocks that you're really seeing leading the losses today are large cap technology. The likes of Apple, Amazon, Nvidia, Tesla, they all also are lower and, of course, are huge heavyweights, huge drags on the equity market. Nvidia is down 4% for Apple, Amazon, and Tesla. They're all down in the ballpark of 3 percentage points, Anna.
Kaylee, Coming up on the program then, Koku Agbubloa will be joining us, head of UK research at Societe Generale. What does he make of the changing, shifting, hiking expectations with regards to the Fed? Is 75 basis points on the table? Is it on the table this week or later on in the summer? And Bitcoin at its lowest level since December 2020. More on crypto ahead. Plus, the latest warning from China to Wall Street. Don't reward top people too lavishly. Read more by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kayleigh Lyons in New York, Anna Edwards out in London. Now, we are looking at 175 basis points of hikes being priced into essentially the next three meetings for the Fed. Ven Ram joins us at Bloomberg Markets Live now. And Ven, a lot of people are saying this means a 75 basis point hike is a done deal. I could imagine the Fed saying, you know what, this inflation situation is serious enough for us to go 100. Is that a possibility?
It is definitely a possibility. It's definitely something that the Fed should be looking at, but it's not something that I think all the same that they will do, because inflation has been streaming higher for months now, and we've already seen their response. It's that they want to go at 50 basis points, and the only thing that's holding them back, rather than going at the 100 basis point pace that you mentioned, is the fact that they don't want to shock the economy into a recession. That is very much in their calculus. And
would stop inflation.
Sorry?
It would likely slow inflation down, wouldn't it? A shock maybe is what this market needs.
Absolutely. I mean, I think that the Fed should have gone much earlier, as I've been saying, and they should have come in and out of policy emergency meeting and then raised rates. And that would have delivered the shock and awe that the markets need. But given the way this particular Fed and Powell operates, they are very clear about one thing. They don't want to surprise the markets. And considering that they've teed up 50 basis points, I think they will go with 50 basis points. And it would be interesting to see Powell then say whether 75 basis points is on the table for subsequent meetings.
Okay, and that ties in with what the views of a couple of guests I spoke to in earlier TV programming, Ven. Briefly, the European story, we see two-year yields in Italy really on the rise, and the pace of this is really speedy. I mean, we're at 1.8% on the Italian two-year. It was 1.2% before the ECB meeting. How long do we keep up this pace of gains in yields?
I think that, both front and back end yields in Italy have got a lot more to rise, simply because bunds are rising. And if bunds go rising, Italian bonds, which have a higher beta, will have to rise even more in a much more accelerated fashion. And that is likely to cause a lot of political noise in Italy because of what's happening and the optics of it. Definitely fragmentation is a risk, but it's not a risk at this point. But if we see yields rising much more in the coming weeks, we can see the ECB coming out in full force and saying that, look, we have a plan B to backstop these peripheral yields.
Okay. Ven, thanks so much. We will listen out for any commentary we get then from the ECB, Ven Ram, on the markets there. And remember, you can get more market analysis. Check out MLIV Go on the Bloomberg terminal. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
After Friday's hot inflation data, traders are pricing in 175 basis points of Fed hikes by September. Stocks and bonds getting sold as a result. The 10-year at 323. The S&P set to open in a bear market. We'll discuss it with Koku Agbabloa, head of UK research at SocGen, next. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Sea of red. Global stocks plunge and bond yields surge following Friday's shock U.S. inflation print. Investors now pricing in 175 basis points of Fed hikes by September. Over in Asia, the yen sinks to a 24-year low as the Bank of Japan's governor delivers his clearest warning yet that a rapid slide in the currency is damaging the economy. And crypto crumbles. Bitcoin joins the broader sell-off, sliding below $25,000. The lender Celsius freezes withdrawals, further eroding confidence in the space. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, a lack of risk appetite, it seems. And we're still dealing with all of the fallout from Friday. And we're not going to hear all that much. Well, we're not going to hear anything from the Fed until Wednesday. They can't steer, they can't guide us in our thinking as to what to expect.
They could. I mean, they could always do a surprise announcement. It's happened in the past, but it doesn't look like that's the kind of thing in the cards for this Federal Reserve. Take a look at what we're seeing in S&P futures. I would say we haven't seen these kind of numbers on S&P futures in a long time, except that we saw them on Friday, not pre-market, but S&P futures at one point Friday were down 2.9%. Still, this is a big drop, considering the fact that we were off in cash trade almost 3% on Friday, 2% on Thursday. So risk assets just selling off. I think it's the worst quarter for the 60-40 portfolio since 2008. Dan Curtis, our producer in London, pointed out to me when I said that we're also seeing a sell-off in bonds, right? 323.45 on the U.S. 10-year yield, getting back to a level that we haven't seen since 2018 and almost to those 2011 levels on the 10-year yield. NYMEX crude coming down as the COVID numbers start to, and some measures start to freak people out in China again. Right now, 119.34 is the level for Texas Intermediate. And then Bitcoin, an unbelievable drop. This is 12% from midnight, but of course, we've been holding it very steady at that $30,000 range, and it looked like we were never moving out. I was going to eject Bitcoin from my board, but now we're off more than $5,000, almost $6,000 from that level at 24,120. As you said, the fact that Celsius is freezing withdrawals, really spooking people in this market. Kaylee, what do you see in terms of pre-market movers?
Well, Matt, I really feel like you manifested what we're seeing in Bitcoin because you were getting so bored with it in and around 30,000, and now we finally have a breakout of that. And because of the fact that that breakout is lower, you are seeing crypto-related equities moving substantially lower in pre-market trading as well. The likes of MicroStrategy, kind of a big Bitcoin proxy stock, down about 17%. You have Coinbase, the crypto exchange, down nearly 12 percentage points as well. And it's not just the crypto players that are under pressure. You are hard-pressed to find really any stock in positive territory in pre-market trading, but the ones creating the largest drag on this equity market are those large-cap technology names, the likes of Apple and Amazon, each down more than 3%, Anna, and it is hard for a market to hold up when those stocks are not, Anna.
Yeah, absolutely. In the US, European tech plays a different role, but European tech also under pressure here. So the Stoxx 600 in the European session now 2.5 hours into our European trading day, down by just over 2%. And of course, some of these markets in Europe, to Matt's point, lost more than 3% on Friday, lost more than 5% if you're talking about the Italian market. So we have some serious downside moves here on European stocks. The technology sector in focus, as I mentioned, down by 4% in today's session. The Italian 2-year yield helping us to focus on what's going on in sovereign debt here in Europe as well. So we're seeing the market pricing in further hikes from the Fed and also from the ECB. And as the ECB steps away as the big buyer of sovereign debt in Europe, what does that do to spreads between Italian and German bunds? And so we're certainly focused on that. 1.9% the yield on the 2-year. This number is moving up fast. Go Ahead Group, I put this one in here. This is a bus company that does bus services across the UK. Apparently the number of bus journeys being taken really on the rise as people try to find alternatives to driving cars as that becomes more expensive. And a reminder that there is still some M&A happening in this market. This business has received multiple bids, it seems, Matt.
All right, so we'll continue to watch what's going on in Europe as well. Well, it's a global sell-off, isn't it? So it's happening around the world. Right now, markets pricing in 175 basis points of hikes from the U.S. Federal Reserve by its September meeting. That includes at least one 75 basis point move if you don't think they'll go over 75. They could do 150 and 25 or 25, 50 and 100, et cetera, and so forth. Let's listen to what Optima CEO Octavio Morenzi told us this morning.
I fear we're drifting into a similar scenario here where the Fed at some stage is going to have to really increase interest rates at a remarkable level, not just 75 basis points per meeting, but like 100 basis points or more very, very regularly every single month to get inflation under control.
So there is another way if the Fed were willing to make that step. Koku Agbabloa joins us right now, SocGen's head of UK research. Koku, doesn't seem like a lot of people put that much faith in the Fed, that they could actually take such a shocking step.
No, actually, because they also have other tools like, the runoff of their balance sheet. This is also a powerful mechanism in terms of sort of mopping up liquidity in the system. But there's also an important element to bear in mind is that if you look at the five-year break-even inflation, it has been quite stable compared to the very aggressive dynamic we're seeing on the realized inflation front. So what this suggests is that the long-term inflation expectations are still anchored, and the Fed ultimately realizes that its monetary policy, it takes 6 to 9 months before having a real impact on the economy. So being steady and not panicking too early I think it is essentially important in terms of credibility for central bank.
So, Koku, does that mean that 75 is also off the table for this week? And if it is, does it mean that we probably will get 75 later on in the summer?
Well, I think it will be very data dependent. I think clearly the market is pricing at 75, but ultimately it's something that would be unprecedented. One thing to mention on the data last week, you also noticed that core inflation was lower than the previous month, even though it was slightly higher than consensus. It was the headline inflation that was higher because of food and energy dynamic being very strong, mostly led by essentially gasoline prices moving faster than oil prices because of refining capacity problems. So we are clearly close to the peak of inflation, and there are essentially commodity and energy related volatility. But I think it is important to take a step back and realize that it is not a question of if inflation will peak, but a question of when it will peak, and we are close to that peak.
Okay, we're still looking to get to that. If you look at bond markets and the clues they're giving you then, Koku, I mean, we've seen 2s, 10s inverting once again. And then when you look at expectations for rate hikes and then to rate cuts, it seems that the second half of 2023, the market now expecting the Fed to cut. So do you think that the end of the hiking cycle is just getting closer and closer, that the longer that inflation stays at these elevated levels?
Yeah, absolutely. This is one of the things that was different in the sell-off we had last week compared to previous sell-off, because the oil and gas, mining, sort of basic resources were the sectors that were still up year to date and were typically benefiting from higher commodity prices, and also financials. And this time around, you're starting to see those mining, commodity-driven sectors down, similar with the bank stocks, which typically sends you a signal that the market is worried about a recession. And this is clearly one of the collateral damage of reining in inflation aggressively, and the market is fearing the last shoe to drop ultimately.
So, Koku, for you, how much greater are the odds of a hard landing this morning than they were at 8:29 a.m. Eastern on Friday?
Well, I think they are clearly higher, but I think it is important to also bear in mind the sort of the question of is the glass half full or half empty. There's still a tremendous amount of cumulative excess savings that is buffering this sort of cost of living crisis, but the odds are clearly higher than they were last week.
So if that's the case, and a hard landing is potentially a more likely scenario, and growth is going to be an issue going forward, how much higher can yields realistically go before the bid for haven comes back in?
Yes, that's a very good question, because we have to factor in the risk of sort of a balance sheet runoff, which could create this supply-demand dynamic where yield could go much higher than where the fundamentals would dictate, as asset managers essentially de-risk their portfolio because they're literally losing money from every asset classes today. So I think, you know, a 3.5 level would be shocking, but it is very difficult to take into account the negative convexity dynamic that could push yield much higher. But I'll say 3.5 would be an interesting tipping point.
We just saw today, Koku, the VIX finally go above 30. I was shocked it didn't on Friday. But we've seen this kind of slow grind down. Admittedly, big moves in markets, but not capitulation, right? What do you need to see before you can say, you know, the market has given up the ghost?
Well, you need to see the sectors that were benefiting from high oil prices start to roll over. And this is one of the factors that kept dispersion or low correlation within the equity indices, because you had commodity, retail or consumption or demand-sensitive sectors already being down 30 to 35%. And at the other end of the spectrum, you had commodity and sectors with strong pricing power that were holding up the market. So now we see those strong sectors rolling over because there is a pricing of more demand destruction. Then you will see correlation going up and the VIX ultimately breaking to new highs. But I don't think we're there yet. I think the jury is still out in terms of whether we're going to have a strong or, let's say, a hard landing, completely destroying demand more than what the saving or excess savings is doing today, because you still have to realize that sort of corporate balance sheets are still very strong in some aspect of the market, But it is true that the credit market is sending some very worrying sign as well. So we are at the interesting tipping point today.
Koku, thanks so much for your time. Koku Agbibua from Societe Generale, thank you for joining us. Coming up on the program, we'll get to the big moves in Bitcoin. It's at its lowest level since December 2020. More from today's crypto report next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Well, crypto lender Celsius has paused withdrawals, swaps, and transfers on its platform, fueling a broader sell-off already taking place in digital assets. Bitcoin now at its lowest price since December of 2020. We are south of $24,000. Mike McGlone, Bloomberg Intelligence commodity and crypto strategist, joins us now from Miami for more. So, Mike, we've been in this range, $2,000 or $3,000 south of or north of 30,000 for weeks now. We have finally had a material breakout of that to the downside. How much more further can this go until some kind of technical support kicks in?
Well, hello, Kaylee, and good morning. I think what you're seeing is the beginning of the great reversion of 2022. And it's cryptos was the highest beta market going up, so it's the highest beta market going down. So I think the next key levels are Bitcoin and Ethereum has been a key indicators around 20,000 in Bitcoin, Ethereum around $1,000. But the key thing that shows the significance of Bitcoin told us on Saturday morning when it started breaking down that this was going to happen in all assets. And that's what's really changed is Bitcoin is going to come out of this ahead. But I think the key thing to think about is when people say inflation is not transitory anymore, you got to look on the streams and say that shows you how transitory inflation is going to be. And the next key issue is going to be deflation. But this time it's going to last a while because all assets are going down. And so to me, big cryptos and Ethereum, it's just the first, they're the good leading indicator now.
By the way, in terms of Ether, there was this story that Lido Finance has accumulated 31% of the stake for the new blockchain, the merge, and that the difficulty bomb hasn't been set off. Now, I know that's a lot of jargon, but it's basically to say that we're not going to switch to proof of stake from proof of work maybe as soon as we thought we would, and it's already been delayed for so long. What are your thoughts on POS, Mike?
Bumps in the road, Matt. It's one thing about the technology. I don't understand it so much, but we fully expect bumps in the road, and we're getting them. It's that we should expect. But I think the key thing to think about in cryptos here is we're going to look back in history, and when people, my grandkids say, hey, Grandpa, what was Shiba Inu? And they'll say to me things like, you mean you can't add value to the stock market by just splitting stocks? This is all assets, and even bonds are going down. It's just cryptos are down the most. But the thing about Ethereum, what it's doing is revolutionary. It's like it's making crypto dollars and stable coins happen, and they're the most widely traded assets. So you got to look at it 5-10 years from now, Mike, what they're really doing to the infrastructure.
We're not seeing, I mean, it isn't all assets because gold hasn't tanked as inflation beats expectations. And frankly, a lot of people are out there saying, I thought this was what Bitcoin was supposed to do. It's supposed to be a hedge against inflation. The scarcity is built in. Why isn't it working?
It will eventually, Matt, but the world's best performing asset needs to come back a little when the Fed sees the Fed's taking away the punch bowl. And that's the key thing to think about here is the markets are doing the tightening for the Fed. So look ahead a year from now, the issue is going to be easing, but they can't ease because we've all learned that lesson. We'll never go back and create the kind of liquidity we did because inflation that came out of it. But it's what happens looking forward. I think the key things to come out of this ahead are Bitcoin, long bonds, and gold. And look, even gold's getting hit today. And those of us who remember trading in 2008, you hit gold right away, but then it came back.
And let me ask you, sticking with the crypto space then, Mike, let me ask you about Celsius. Things got too hot for Celsius, it seems. They had to freeze withdrawals, that fueling the market rout. I mean, what do you read across from that particular instance, just in the same way that we were asking about around Terra USD and Luna? What do you read across from this particular episode?
The tide has gone out. We're seeing who's wearing clothes. Now, Celsius was one of the first to provide interest and provide income to cryptos and stable coins, and now they haven't said they said they're going to come back, but if they fail, that's a big problem. What's really been happening in that space, it just got literally too excessive. It was the excesses of excess, and we're pulling that back, but it depends. If they fail, that's going to be an issue. I think right now they're just holding back until things calm down. But again, the tide went out. We see who's wearing clothes. Terra Luna was just silly, you know, algorithmic stable coins. But we're seeing the legislation coming from the bipartisan bill where we're going to focus on crypto dollars, and they're going to have to hold the proper collateral. So I think that's going to work out okay. But right now, we're just, the markets are doing the tightening for the Fed. So we're not going to have to worry about the Fed if this keeps up.
All right, Mike, thanks so much for joining us. Mike McGlone there from Bloomberg Intelligence out of Miami. Tune into Bloomberg Crypto, by the way, every Tuesday at 1 p.m. New York time, 6 p.m. London. This week, we're going to hear from the CEO of Webull, a commission-free trading platform, so long as that's allowed by the SEC. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. That Boeing is going to compensate SpiceJet in form of cash and aircraft. Gwalior Airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think you've got to be very modest about what we know about this inflation process, and I fear that it's still going to get worse. We may well get to 9% at this rate.
Fed's forecasts have tended to be much too optimistic there, and I hope they'll recognize fully the gravity of the problem. When inflation is as high as it is right now and unemployment is as low as it is right now, it's almost always been followed within 2 years by inflation, by recession.
Mohamed El-Arian on CBS, Larry Summers on CNN over the weekend. Tom Keene joins us now, anchor of Bloomberg Surveillance, to talk about what he makes of inflation's impact on the markets. And Tom, what is your single best chart of the day?
Well, the single best chart is about the markets. The market move is a story this morning. There is no other story. It is in bonds and it is in equities as well and expressed through commodities, but far more foreign exchange with new dollar strength. We go to the equity market, and for global Wall Street, it is about the VIX. And just looking back to 2006, you've got some stasis there between once-in-a-lifetime events, the financial crisis, the pandemic. And up we go again, breaching above 30 right now, Matt, 32.84, up 5 big figures, the Dow, negative 627.
Yeah, Tom, some of these market measures of stress on the move, and some of them on the move pretty quickly. What is the lineup of guests that you have to take us through all these market moves?
Well, we're doing two things. We're blowing up the show. We've got some wonderful people we had on other topics. We've said goodbye to them. We'll see them tomorrow or the next day. We're going to focus on the markets. Lori Calvasina with a really important note. She really popped the zeitgeist Friday evening, and she will join us as well. Francis Donald on, can I editorialize, Anna? Is it too early to editorialize?
I say yes. I have no power or control, but I'm saying yes.
Well, okay. Well, Anna, you always have power and control. And the answer is 75 beeps is a reach. That's what I hear within the literature. We'll talk to Francis Donald about that as well.
Well, maybe that's part of the problem, right? That 75 basis points is too much for this Fed. Tom Keene there, co-anchor of Bloomberg Surveillance, joining us to preview his program. Now, we may look back 5, 10, 20 years from now and say, why were we talking about the markets on a day like this? This could be the turning point, Anna, for our society. We may have to send a soldier back from the future in order to stop what's going on at Google.
I can see where this is going.
An engineer at Google has been dismissed, suspended, I believe, with pay, because he says Google's AI, its artificial intelligence, its chatbot has become sentient, self-aware. He says this chatbot that Google's developing may deserve human rights. Maybe it's maybe we've reached peak woke here, but it's possible that this artificial intelligence has gone too far, according to this engineer, although Google says they've dismissed his claims and say, no, it's no big deal.
Yes, well, they say it's not sentient, don't they? I mean, I can't work out in 20 years, will we look back and say, yes, this was the worthy topic of really serious science tech books, or will we say this was sci-fi and that's where it stays? But we will see, won't we? I think you were alluding to some Hollywood blockbusters which have dealt with this in the past. Let me tell you what is on my mind today, and that is also on your mind, I know, Matt, and that is how much hiking we're going to get from global central banks. If 75 is too much for the Fed this week, is it going to be possible we'll see 75 or more? at later meetings from the Fed. I know, Matt, you have your thoughts on that, but we're also going to hear from the from the Bank of England this week. We got some GDP data earlier on this morning. We showed 2 months of back-to-back shrinking in those GDP numbers, negative GDP numbers month over month. And so how many hikes can we get, and of what size will we be able to fit in before we see real slowing in the UK economy? The Bank of England, they're meeting this week, as is the Bank of Japan. And we know that the weakness in the yen has been a real talking point. Their decisions, though, Matt, really different. They're still dealing with yield curve control there.
Yeah, I mean, there are central banks around the world that have different issues to contend with than we do, than you do, than Europe does, and Japan is certainly one of them.
That is it for the early edition. Surveillance is ahead. As you heard Tom say, they've ripped up the script. They are going to be talking markets, helping you through this turmoil. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Has got to regain its credibility that it is serious about inflation fighting.
We're dealing with a little bit of a stagflationary environment here.
I think it's important to realize that we've got a lot of emotion here in this market.
Investors, they've become very accustomed to good returns, low volatility, and always being supported by the Fed.
This economy is not falling off a cliff today, and actually is quite resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A most extraordinary Monday. Kaylee Lyons in for John Farrow as well. We welcome all of you on radio and television worldwide to markets to be polite on the move. We'll get to the data check, Dow negative 599, out 5 big figures on the VIX. But Lisa, I want to get right to the distinction of the moment. This is not about the stock market. It is about declines in both equities and bonds.
And what you see is on the front end, people saying the Fed has to do more. Central banks have to do more. The inflation read that we got last week did not give anyone comfort that it was decelerating. And not just that, but inflation expectations among consumers starting to become a little bit less moored. You're starting to see them climb in a way that they haven't since 2008.
You know, I look at the drawdown. Let's get right to it, the buy part here. I'm going to go to the Dow a lot today just to harass John Farrow. But also when things get ugly, people mentally switch over from the pro index, the SPX, with the VIX. We quote the VIX, 5 big figures. But they go to the Dow sort of as the mother lode of decades and decades and decades of these moments. And Lisa, we've got a drawdown Dow, negative 16%, and full faith and credit bonds, negative 13%. Guess what? I've never seen that.
No, you've never seen that. I've never seen that. I'll point to another index, just not to tweak John Farrow so early in the morning, looking at the NASDAQ. If you take a look, it's down 27% year to date. It's about down nearly 3% at one point ahead of the market open in futures. That would bring it down, getting closer to that 30% drawdown, Tom. If you want to start looking at massive figures, these are massive figures at a time when markets are recalibrating to a central bank, all central banks that have to do more.
Little longer data checks today. Kayleigh, I want to get to you on the economics and the politics of an adjusted Fed. We'll talk about inflation expectations on Friday, which shocked economic Wall Street. But Kayleigh, Greg Valliere publishing moments ago, thank you, Greg, you were going to be with us today and stepped aside for the global Wall Street pros. Greg Valliere says 75 basis points more likely in July. So Kayleigh, is that 50 now and 75 in July?
That's at least what the market pricing would indicate at this point, Tom. 175 basis points by September is what traders now expect. So in all likelihood, that is at least one 75 basis point move. Of course, you have Jeffries, Barclays saying that 75 basis points could actually come this week on Wednesday. There is a question, though, Tom, of if this Fed still wants to keep expectations in the market in line with what it does, or is this a Fed that, given the upside surprises in inflation, is going to become a little bit more willing to take the market by surprise?
The Fed decides Wednesday. We will be there with coverage in the afternoon of what has all of a sudden become a more than important meeting. I want to go through the data check now. Lisa, you can wander to the wall and use my walker, Lisa, if you have to after the wild weekend you had. But let me talk about the data check right now. S&P futures are minus 93. Dow futures at negative 600. Everything correlates. Maybe gold's a little off the mark with a VIX out 5 basis points. The yield structure is absolutely original. And because Lisa and I miss John so much, we're going to start with the Italian yield popping out. And on a deviation basis, chart banner, I think you've got this banner. The Italian-German spread is a great European litmus paper, and it shows two things. One, AC Milan won this year, and it also out 2.7 standard deviations. Dollar strength, we'll get to Mark Chandler in a moment, with yen beginning to look at 135, euro 104.58, and sterling to end at 122.02. My word, a 119 sterling, Lisa, we are unprepared for that. What do you have?
We are unprepared for the week ahead. And really what I usually do at this segment is talk about what to expect in the day. But right now, the day is all about markets, and it's preparing for what to expect this week. Wednesday, we get that FOMC rate decision at 2 p.m., and Fed Chair Jay Powell gives his news conference at 2:30. This is the reason why two-year yields today are popping to the highest levels that we have seen since 2007. They have exceeded 3% and have continued onward to 3.2%. The pace of move has been dramatic, and suddenly we're talking about a 75 basis point rate hike getting baked into expectations possibly as soon as July. This is a fast-moving market, and it is doing it on the heels of inflation expectations. And if you take a look at the University of Michigan Consumer Sentiment Survey on Friday, this is what caught people's attention, that the 5 to 10 year inflation expectations rose to above 3%, 3.3%, the biggest move, and frankly, the highest level that we have seen going back to 2008. People are expecting this inflation to be sticky. Thursday, the Bank of England rate decision after today, what we got in the economic data front that was really not comforting. interesting considering the fact that it's the second month in a row that they've seen negative growth in GDP. What you're seeing on the two-year yield, yes, you are still seeing it rise to the highest levels going back to 2007 in the United Kingdom, 2.1%. But over the longer term, people are bringing back those expectations because they do not see a good outlook for the economy. They are hiking into weakness. And then Friday, I normally wouldn't be talking about this. The Bank of Japan policy decision. What's the policy decision? Keep things where they are. But right now, the policy decision is being driven by the yen. And Tom, you talk about this all the time. The weakening in the yen is a linchpin of global markets. And that linchpin is telling you that right now we are looking at diverging monetary policies that are unsustainable for Japan. You can see the yen weakening at one point, it's the weakest since 1998 this morning. And this comes as they keep rates where they are. They try to manage that market, which is no longer a market, and it's being borne out in the FX market. That's sending a pretty strong message, Tom.
One board to get through the morning here, and I really want to introduce this as somewhat of what I see in the Launchpad board. The VIX out 32.85, 5 big figures. The Dow, you end up flipping to the Dow in times of crises, and here we are, negative 589, a little bit worse earlier. The 2-10 spread was negative a moment ago. Now 3 basis points is infinitesimal. We are back to a level curve. And Euro Swissy was a 103 handle here coming on up. Right now, Mark Chandler joins us, Chief Market Strategist at Bannockburn, and just wonderful at the astrology of the market, an acclaimed book on the stars, the astronomy of our market a number of years ago. Mark Chandler, what is the item you're watching to glean the astrology of the market?
I really think it's a question now of momentum. I think you guys are right. The Fed funds future, they're pricing in 175 basis point hikes in the next 3 meetings. So that implies a 75 basis point hike sometime in the next 3 meetings, counting this week. So I think that the dollar's got a lot of upside momentum here. And I think that the talk of intervention still seems to be misplaced.
So, Mark, when we look at what's being baked into the market, have we reached peak rate hiking expectations? Have people gotten over their skis in terms of the hawkishness? Or are we looking at a game change for the Fed where suddenly they have to respond?
Well, I think that the Fed, for me, I know that a lot of people are critical of the Federal Reserve, that they've lost credibility because it's so far behind the inflation curve. But I think that, to your point, we had 2 numbers last week. One, as you mentioned, the consumer confidence, the consumer number for inflation expectations jumped. And at the same time, the consumer sentiment fell to levels that are associated with recession. And the market believes, it has a lot of conviction, that the Federal Reserve is going to follow the inflation expectations and not the potential sluggishness, possible contraction in the U.S. economy. Remember, we contracted in Q1 as well. And so we could possibly be having second quarter of contraction here. But the market's convinced the Federal Reserve is going to become more aggressive rather than less aggressive in the face of this economic weakness.
Okay, so the market is becoming more convinced about more tightening from the Federal Reserve, Mark. It is not looking for any tightening coming from the Bank of Japan. When is Kuroda going to have to give in with a yen that hit the weakest since 1998 earlier today?
Well, to your point, I think that the Japanese comments have been very clear. They're not concerned about the level that the dollar-yen's gotten to. They're concerned about the pace. And so what's the appropriate tool for the pace? Might not be actual material intervention or a change in policy. If anything, it seems that the BOJ is doubling down on its policy, reinforcing the idea that it's going to cap the 10-year yield at 25 basis points. It did so today, even though the yield got a little bit above there, and they increased their bond buying for tomorrow. And so this tells me that the Bank of Japan is not about to change their policy, and that the yen weakness could be addressed by the talking about it, that is to say, a very low level of on the intervention escalation ladder, just taking a small step on that. I think we really have to wait till the G7 meeting, the G7 summit later this month, for the G7 to also endorse the idea that while markets should determine exchange levels, that volatility could be undesirable, and that's where we are now. So I think that's a question of verbal intervention, not a change in monetary policy.
The volatility question, Mark, is absolutely key. How does renminbi fold into that? I think it's overplayed in the zeitgeist, but nevertheless, it is the Chinese yuan.
Yeah, so today the dollar gapped higher against the Chinese currency. And what's happening there, I think, is that many of us thought that maybe that COVID zero policy was being effective and that Beijing and Shanghai were going to reopen. But today, a big setback. Beijing schools opening have been delayed, more lockdowns and restrictions introduced to Shanghai. And so I think that a part of the issue, I think, is broad dollar strength. The other is a bit of disappointment with what's going on in China.
Mark Chandler, thank you so much on short notice with Bannockburn today. We're really trying to blow up the show here, folks, to give you the market coverage you need with futures at -88, Dow futures -563. Lisa, I think all of us realize the import of the University of Michigan inflation expectations numbers. I sold them on Thursday and Friday as well. Chart banner, give me the banner here. And for radio, I'm going to talk this through. June of 2008 is the last time we were here. And Lisa, what is shocking is we went to a 2.2% inflation expectation just before the pandemic. It is amazing how far we've come across the pandemic.
The surprise for a lot of people was how much it ticked upward, despite the fact that the Fed has talked about their being aggressive. And this is what has gotten people concerned. Consumers are going out there. They're filling up their tanks. They're seeing it's $100 or more, given how quickly the gas prices are moving up. And that is unmooring expectations well beyond where the Fed wants them to see.
For those of you for and against Bitcoin, we will keep you abreast of that move. It's bouncing now off the 23,000 level, just above 24,000. Stay with us. More market coverage, more data checks this morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Chinese military officials in recent months have reportedly told U.S. counterparts that the Taiwan Strait is not international waters. That is said to have caused concern within the Biden administration. The U.S. and allies say much of the strait constitutes international waters, and they routinely send naval vessels there during freedom of navigation exercises. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes. But Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential elections from his result 5 years ago. A software engineer on Google's artificial intelligence development team has gone public with claims of encountering sentient AI on the company's servers after he was suspended for sharing confidential information about the project. The Alphabet unit placed Blake Lemoine on paid leave last week on claims he breached the firm's confidentiality policy. And crypto lender Celsius Network paused withdrawals, swaps, and transfers, triggering a broad cryptocurrency sell-off and prompting a competitor to announce a potential bid for its assets. Doubts about the high-yield backing products, such as those Celsius offers, have intensified after tighter monetary policy across the world helped curb demand for riskier assets. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I think you've got to be very modest about what we know about this inflation process, and I fear that it's still going to get worse. We may well get to 9% at this rate.
9% inflation. Are you ready for that in the United States of America? There's a few other places that are feeling that right now. Maybe we'll see some chat on that out of Europe this week, but really extraordinary. We welcome all of you on radio and television. Lisa, quickly here, Bitcoin can't find a bid, just down to new lows under 24,000.
You know, honestly, we didn't get the best quote this morning from our previous guest saying that it's amazing that something can fall that's far that's worthless. So people are looking at how far this is.
There's a lot of people, not that I know anybody. I'm asking for a friend, Lisa.
I mean, look, I think it's fascinating to me just to see the froth taken out of the market. And it goes back to that Warren Buffett quote, right? When the tide rolls back, you see who doesn't.
They came to me and said, do you want to do the crypto show? And my people told them that would probably not be a good idea.
Just rail against
Kaylee
it.
Lyons doing a crypto show. Kaylee Lyons, how big's the wake this week for the crypto show?
It's going to be interesting. Tuesday, 1 p.m. So don't forget to tune in tomorrow afternoon. But Tom, Matt Miller and I have been joking for weeks that Bitcoin has become terribly unexciting. We've just been in this range in and around $30,000. It is a lot more exciting with a breakdown below that range today.
Joe Matthew memorized everything Everclear ever wrote, including so much for the afterglow. And we will get the afterglow right now with Mr. Matthew in Washington on these hearings. Joe, I really want to pause in the market carnage that we've got and talk about the next hearing. How will the hearings today theatrically be different than the splash of last week?
Theatrically may not be different at all, save a much smaller audience. You know, we're not in prime time. It starts at 10 o'clock in the morning today. So lawmakers on this panel have their work cut out for them, not just trying to get into people's living rooms and lives at 10 o'clock in the morning, but also to compete with stories like what's happening in this market, what we're hearing from China today. Though they begin the process of connecting the dots. Think of last week as, you know, opening statements. Today they get down to the actual process of connecting the dots between when Trump was told by his his inner circle that he had lost the election and, in fact, was losing it. He heard this long before January 6th. And the pro-Trump supporters who turned into a mob here, the witness that we're going to be watching today, Bill Stepien, former Trump campaign manager in 2020, about these behind-the-scenes conversations we keep hearing about.
And Lisa, meanwhile, there's actual news, including the distance from an island off China to the mainland.
Right. I mean, if we weren't talking about inflation this morning, we'd be talking about Taiwan and what China said over the weekend, that basically the Strait of Taiwan is not international water and that they will command over it if there is any kind of untoward interference from other nations. A direct shot across the bow to the United States. Joe, how concerned are people in Washington?
Yeah, the defense minister in China definitely using the words fighting here with regard to Taiwan. It comes just a day after the Secretary of Defense, Lloyd Austin, made some comments of his own, talking about the U.S.'s Indo-Pacific strategy and how it prefers the status quo when it comes to Taiwan. Look, this is another layer in an ongoing conversation here, a standoff, a dispute, whatever you want to call it. It's decades old. Just more recently, though, has really come into heating up into a war of words here against the backdrop of the war in Ukraine. We really haven't heard much coming back from the administration on this, but stark language coming from Beijing this morning.
Yeah, and as Lisa says, on any other day, Joe, that would probably be a much larger focus. But the fact of the matter is this is the day after the inflation print of Friday, which is a huge political problem for the Biden administration. Yet as they point the finger to the Federal Reserve and say it's their job to rein in inflation, is it a worse political problem for the U.S. if the Fed acts aggressively and as a result you get a higher unemployment rate and potentially a recession?
Boy, that's the $30,000 question inside the West Wing right now, and it's one that the White House would prefer not to answer publicly, thus deferring to the Fed. The president will be talking a lot more about inflation this week, though. He's going to be going to Philadelphia to speak to an AFL-CIO convention tomorrow. To check out the language here in the White House schedule that we got. He's going to talk about building an economy, they say, around the power and possibilities of working people. An economy that rewards work, not just wealth. That should give us a sense of what we're going to be hearing here as the president prepares to talk to this again.
Joe Matthew, thank you so much. Greatly, greatly appreciated. That's great, folks. While Joe's yammering away, I'm looking at my portfolio go down in South. Being in triple leveraged all cash actually feels pretty good here. Joe Matthew, 5 p.m. today with an important show. Lisa, we talk full faith and credit, and it can be the quality of the U.S. or maybe what Italy's doing, 4% yield on Italy. Lisa, I'm only down 68% on my 100-year Austria piece.
Congratulations.
Right now. How about that credit? How is credit corporates doing in America?
So this year, credit's actually done better until about a month ago in terms of how much the total return has been relative to government debt. That is starting to change. I'm looking right now at the average yield on high-yield bonds, on junk bonds, and this hasn't been high yield for a long time. You're getting nearly 8% yield on average from U.S. high-yield bonds now, Tom. This is indicating, yes, that people are concerned about credit. They're also baking in a bigger cushion for higher yields. But this is the conundrum that a lot of people face. We are not facing into a big maturity cycle. Yeah. What's going to make them default? You still have good balance sheets. People are trying to bring forward a recession that has yet to happen, and people are looking at the bottom line and not seeing it in credit. And this is why the Fed's going to keep going.
If you're just joining us on radio and television, we'll do a lot more in the markets today and more data checks. Futures at -91. Dow futures were -600, now -590. The VIX out 5 big figures, well over 30, 32.81 with dollar strength. Sterling, is Farrell paid in sterling, Lisa?
No, he's not. He's paid in dollars. He talks about this all the time. He has a certain level that he'll go back into sterling, but no.
Okay. You know,
not that anyone's trading. Yeah.
122.11.
Why don't you go and quote the Dow again? See if he writes in sterling.
Kaylee, you know, Lisa's all wound up about, you know, when you got Kaylee, I don't know if you know this, Lisa's got the H2 to do the portages up by Tupper Lake. And the EBITDA on Exxon has moved from 27 billion to a modeled 88 billion. I guess they're making money, and Mr. Biden mentioned that this weekend.
Yeah, that they're making more money than God. This is something he has repeatedly come back to, is that these energy companies are the ones that are responsible for higher prices at the pump. He says they're prioritizing profits and returning capital to shareholders over the American people. He is looking for someone else to blame other than his own administration's fiscal policies, which is why also, as we just discussed with Joe, They're trying to point the Fed to the Federal Reserve and say, your problem to fix, or maybe energy companies, you fix it as well.
Lisa, are you filling up, or are you like doing the top thing where you drive and you spend $22 and then you drive some more and you spend another $22?
True story. We actually ended up trying to empty the tank as much as possible to see how much it would cost to fill up the whole thing as a science experiment. So we were on the highway just saying, we hope that we don't run out of gas. Please don't run out of gas, because we wanted to do this science experiment. It was great. We had all the kids in the car. It was fabulous.
32 gallons, top ticket, folks. She got some Matt Miller gallon of gas. It's like Shell, super duper. I think she's out of $250 to refill the H2. We're watching the markets here this morning and the underlying economics of them, with futures at -90, the VIX 32.79. On Chairman Powell, Francis Donald next. This is Bloomberg. Stay with us.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Good morning, everyone. Bloomberg surveillance on radio and television, an historic Monday, no question about it, with the VIX out 5 points, 32.78 on the VIX. Futures at negative 90. As a side story, Bitcoin tanks. No other way to put it. Lisa, let's do this very, very quickly here, and I want to talk about curve inversion. Here's a board I'm looking at that's got a lot of good stuff on it. The 10-year yield is 3 basis points above flat. Crude is off, showing that global slowdown feel. Euro comes down just to a 104, and futures negative 90. Lisa, what's the symbolism of inversion?
At this point, right now, stagflation, possibly recession. I say stagflation first because we haven't gotten inversion, and we've flirted with this level before, and we're looking at a Fed that is now expected to raise rates by 75 basis points as soon as July. And not just that, but I was looking at a Deutsche Bank projection, and they expect that peak Fed funds rate right now is going to reach 4.125% in 2023. That is a level we cannot even comprehend given where markets have been over the past few decades.
I have been data dependent. I've been criticized for calling it a Fred Parler game. Francis Donald agrees with me because Francis Donald is writing brilliant economics for Manulife Investment, asking if her mother-in-law knows who Chairman Powell is. And you note, Francis, that your mother-in-law will drive, she's lovely, by the way, folks, she'll drive 30 kilometers out of her way to save 10 cents a gallon. How does Chairman Powell speak to your mother-in-law?
Well, he's not. He's tried. He said, let me speak directly to the American people. But the big challenge for this Federal Reserve is that inflation expectations, which they're so desperate to control, are really not going to come down, at least in the near term, on rate hikes. Most of the general public is going to see what they're paying at the pump and what they're paying at the checkout, and simultaneously hear that rates are rising. This is going to be a very different communications, or very difficult communications challenge for all central banks. They don't have the luxury of being honest about what control they have on inflation. That's the underlying problem facing Chair Powell, Lagarde, and many other central bankers.
Chairman Bernanke on CNN this weekend. Let's get out his textbook, Abel Bernanke, which is in my hallway at home. Francis, I look at Abel Bernanke, and back in chapter 22-ish, it's about the effect of what the Fed does on finance. If they pop 75 beeps now, or July, or whenever, what does that do to North American banking?
Well, it's a struggle, and it's another strain on the system. We could be inverted on the yield curve again by today or tomorrow. And unlike back in April, you're not going to hear as much pushback that this isn't a signal or a precursor to a recession ahead. Financial conditions are tightening. The economy is slowing. The consumer looks fine now, but all leading indicators suggest it's lower. Geopolitical risk is up. If you made a whole table of challenges for the economy, almost every single one would tell you that for the next 6 to 12 months, things are going to be much more challenging. That's why this is such a difficult situation, because despite all of these leading indicators, we have not seen the central banks blink. In fact, last week we saw most central banks that were speaking actually appear even more hawkish. So the hope that bad news would be good news and to create a reversal in this market, it's just falling away in front of us.
Francis, consumer sentiment at its lowest on record, and your mother-in-law driving 30 extra kilometers to get 10 cents less on a gas can drive around and see a lot of variation as things just climb higher and higher. Francis, at what point does it have to reach peak negativity before you get some response from the Fed that can really address this? Because right now they're between a rock and a hard place. If they actually come out as hawkish, perhaps that will create better sentiment underpinning markets and consumers.
This is a great question. I mean, macro tends to be most valuable at inflection points in the story, and we're not at an inflection point just yet. We haven't seen a blink from central bankers. We haven't materially seen employment start to rise, although some leading indicators suggest that gets better. Now, consumer sentiment, there's a range of indicators. A lot of people focused on University of Michigan last Friday. Consumer confidence, which weights a little bit more towards jobs, doesn't look as bad. But the challenge for consumers is we're going to get retail sales numbers this week. And in nominal terms, they might look just fine, and you'll hear a lot of the consumer is good narrative. But in real terms, every single month, this is a consumer that loses purchasing power. And now initial jobless claims starting to move up, so they're losing purchasing power, and they're going to start worrying about their jobs. That transition from capital to labor, well, it's looking like it was very short-lived, and that's really the biggest challenge facing this consumer right now.
Francis, Mike Wilson over at Morgan Stanley came out and said people are not pricing in the consumer weakness that we are going to see, given exactly how much their budgets are being crimped. You have Lori Calvasina of RBC saying that if we break through the levels, the lows that we have seen year to date, we could get down to 3,400 pretty quickly on the S&P. Do you think that this is all accurate, that people have not taken into account how much the disposable income is getting eaten into?
Two of my favorite strategists, two very good calls. That's the challenge here, is that the narrative has been for the last 2.5 years, there were huge stimulus checks. The balance sheets look good. Debt service ratios are fantastic. But actually, real wages are declining. We're going to start seeing challenges in jobs. And that age-old idea, oh, the balance sheets are really solid. Well, that's where they are now. But where they're going to be in this next 6 to 12 months is more challenging. So that brings me to the question of, when does the central bank really start to pivot? And it looks like what they're telling to us is they can't do it until inflation mollifies. What I'd like to see from Chair Powell this week is maybe some Yellen-type comments. We want to focus a little bit more on core as opposed to headline, and reminding the general public, whoever is listening, my mother-in-law will not be listening, that they can control some segments of inflation, but not other ones. That would be sort of the beginning ceilings of what we could hope for in terms of a pivot ahead. But generally, I don't think this Wednesday we're going to get it. And that's why we're not yet at an inflection point in the macro story.
Are we going to get a hint that 75 is coming in July, Francis?
Oh, I'm not sure. I mean, central banks are trying to open the door. The Bank of Canada did it last week. Previously, they'd said, oh, we're not interested in 75 basis points. And then when asked if they would raise by 50 basis points, they said maybe more than that. I think these are central banks that want full optionality. What we might get, which might be helpful, is a little more symmetry in that optionality. More talk about a September reassessment could be very valuable. But again, I don't think we get that this week. We probably need much more indication that inflation and inflation expectations begin to cool.
Well, they're definitely not cooling yet, Francis. And as you say, the Fed can't be responsible for reining in all of the factors contributing to inflation. They can't do anything about the supply side. How confident are you in their ability to get it down towards their target without a hard landing?
Not very confident if this is their current strategy. So we're reevaluating our forecasts now, and there is a very significant weak patch in most economic models between Q1 and Q3 of 2023. Whether or not it tips the scales into mathematical recession depends what you're looking at. But the real story is this is a material growth slowdown. And guess what? Whether it's recession or not recession, that's not the name of the game here. That's an overly binary type of focus.
Francis, thanks so much. We've got somebody who cares less about us than your mother-in-law, and that's Qantas. Emailing in the evening of Perth in Western Australia. I believe it's Western Australia, 12 hours behind. It's good evening to Qantas in Australia. And he notes that a kilometer, Lisa, I mean, I never get it right. 1 kilometer equals like 0.6 of a mile.
You're not gonna quote that to 17 decimal points. I mean, this is where's the Tom that I know? Yeah. I mean, normally you would go all the way out.
It was like 600 digits of pi.
I know, right? Like I have that.
Because we're nailing Western Australia here, Lisa. Let's talk about commodities. They are part of this pullback. It's a growth slowdown. Copper south this morning.
Right now, when you look at the jump conditions, I'm going to channel a Tom Keene. If you look at the jump conditions, they are there in terms of how quickly things are moving in the commodity space. And it's led Citigroup to come out and said this really is akin to what we saw in the 1970s, particularly with oil and gas, when it comes to the proportion of GDP and the increase that we have seen year over year. That, again, is factoring into these feelings. Perhaps it's not the same as 1970s, but it's starting to rhyme a little bit.
Yeah, Kaylee, one of the differences here, and I don't want to be inflammatory here, is because corn is nowhere near $8 a bushel. But I'm looking at the rice, corn, wheat complex on my screen. I'm looking in Australia at Newcastle coal, which is, I think it's in Queensland, like
someone get Tom
crocodiles. I don't even know. But to be honest, Newcastle coal in Australia has not pulled back. And Kaylee, I think that really speaks to the the tension here of a China opening versus all this other financial gloom.
Big time, because right now, obviously, China's still firm in its COVID zero policy. You saw over the weekend some of those restrictions being put back into place, but there are now commodity strategists out there saying, be prepared when China opens back up, because that is going to unleash even more pent-up demand, and there isn't going to be the supply to meet it. So that would just exacerbate the higher prices we are seeing in commodities really across the board. And that all comes down to food and energy, basic necessities that people have no choice but to pay up for. And if they're paying up for that, when do we start to see real demand destruction for other things?
Some guy in a bar called Platypus in New South Wales emails in and goes, Tom, you moron. Newcastle Coal is New South. I don't even know where New South Wales is.
I know, that's why Kaylee recommended that you get a better Wikipedia.
It's north of Tasmania. I know that. Okay.
You're killing it, Tom.
Let's go back to a data check. Lisa, help me out here. It's a little better tape off the carnage of an hour ago. We were up 5 on VIX. We're now up 4.87. Negative 91 on SPX is negative 88. I'm struggling here, Lisa. Help me out.
You say a little bit better, a little being the operative word. I'm looking at the NASDAQ futures, and I keep watching NASDAQ because for a while people were saying you're starting to see some traders cycle back into big tech as some sort of haven of cash flow. It's not happening, right? I mean, it's down right now at 2.8%. And again, the underperformance of the NASDAQ versus the S&P is something we have not seen to this degree more than 10 percentage points at this point, or about 10 percentage points going back to the early 2000s, to the dot-com bubble. How much more do we have to go in terms of repricing if the Fed were to really act in a massive way? This, to me, is shocking because this has been the bedrock of so many portfolios, right? What proportion of the overall index, some crazy amount, are these stocks, Tom? It's a big deal.
And the yields are moving as well. Let's do a Faro data check here on German yields. 1.1% on the German 2-year. And of course, that vaults out to the Italian 10-year at 4%, which is sort of the bond roulette wheel of Europe. Really interesting right now. And again, dollar strength this morning. Stay with us with more data checks through this market turmoil. Futures at negative 88. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The UK economy shrank in April at the sharpest pace in more than a year as the government reduced its COVID-19 testing. That is pointing to risks that a broader contraction is underway. Gross domestic product fell 3% from March when output declined 0.1%, according to the Office for National Statistics. And China is starting to reimpose those COVID-19 restrictions just weeks after a major easing in key cities. The actions is raising concern the country may once again employ strict lockdowns to control its outbreak. Beijing reported 45 new local cases in Monday after having single-digit cases on most days last week. The yen fell to a 24-year low and Japanese bonds tumbled Monday, prompting a warning from the Bank of Japan. Rising global interest rates are seen to be an issue there. The currency fell more than 0.5%, the lowest since October 1998. The yen has tumbled almost 15% this year. It is the worst performing of the major currencies. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes. But Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential election from his result 5 years ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front row, the best seats in the house for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
China changed the picture in the sense that we have a much longer lasting and persistent inflation than we would have had in the past. The supply chains are completely broken. It looks like, given the zero tolerance policies that President Xi has put in place in China, it's unlikely the supply chain is going to come back anytime soon.
He was absolutely brilliant. I believe it was Friday or Thursday last week. William Lee, of course, with all of his Pacific Rim work for the IMF, and now with Michael Milken at the Milken Institute. I thought Dr. Lee was just brilliant on the challenges of the Pacific Rim centered around COVID, which is something we've not talked about with the miracle of vaccines in America. We're going to give you more market checks here. The -91 SPX is now -87. A little bit of a quiet in the carnage overnight as well. Let's do that. On radio right now, we're featuring oil a little bit south. We did have curve inversion momentarily, 4 basis points rather, on the difference in yield between the 10-year and the 2-year. The difference in COVID reality in China is real. I know Elisa and Kaylee want to talk about China and the markets, but I've got to start with a single headline in the Blur this morning of Beijing and real doubt about COVID. What is the Bloomberg reporting on COVID and the ability to restart a broken China economy?
It seems to be a backward step, Tom, happening up in Beijing and Shanghai at the moment. So we had been saying that restrictions were eased in recent days, eased quite quickly actually. But over the weekend, we get news of another tick up in cases, both Beijing and Shanghai, 50-odd in Beijing, a lot of which is linked to a single bar, by the way. So they've kept schools closed up there, and they're implementing another mass testing campaign in some parts of Beijing. And of course, in Shanghai, similar kind of story, new restrictions around dining in, for example, being reintroduced. This was only after the city opened up, or has reopened after that bruising 2-month lockdown. And I think a lot of people today looking at this news over the weekend are really saying this just goes to show you how challenging COVID-0 is going to be for China in the weeks and months ahead, because we all know the backstory with Omicron and how transmissible it is. But people are asking how long can this go on and how can China get that balance right between the economy and, of course, trying to contain the virus. So I think big question marks now, Tom, remaining over China's whole COVID strategy.
And China is kind of at the core of how bifurcated the world economy is right now. On one hand, prolonged shutdowns are going to slow the economy for lack of demand, lack of production. On the other hand, it could help the commodity picture. Is that really the way that we should be looking at this? If they reopen, that could be yet another shock, as Kaylee was saying, in terms of commodity demand.
Yeah, well, Lisa, you're right. People make this point, of course, that if China's factories are offline, then surely that will have knock-on consequences for energy consumption and, of course, buying bulk commodities like copper and iron ore, etc. There are different ways of looking at it, of course. We have actually seen a fairly quick rebound in China's factories and China's exports over recent weeks as the reopening gets underway. But the bigger issue that might be coming into play for the manufacturing story in China is actually slowing global demand. I mean, we hear from manufacturers a lot. We've spoken to factories in recent weeks, and they're all saying that their order books are actually slowing down. So forget the supply side story for a moment. They're saying their end demand is weaker in Europe and the US. So if their order book is weakening, that speaks to less activity. And then to your point, that could speak to a source of disinflation for the global economy. And plenty of economists are saying China could become just that this year, a source of disinflation rather than what it was last year, a source of inflation.
So, and at this point, with the shutdowns, the rolling shutdowns, and the feeling that at least ahead of that Party Congress meeting later this year, we're not going to see an end to zero COVID, that China is probably going to grow sub 4% on a GDP basis, and that the rest of the world is not necessarily increasing demand to offset that.
This seems to be the worry now facing China. So you've got two issues going on, Lisa, like you say. You've got the underground domestic problems, and the domestic problems are, let's not forget, the housing slump as well. That's still a big drag on China's economy. The workout in the housing sector, that's up to maybe 25% of GDP, so that's happening. And you've got the ongoing disruption from COVID-0, which is having a clear knock-on both consumer confidence, how can people go about their daily lives when they are concerned about the restrictions coming at any moment, and like the factory side of things we've just spoken about. But then you've got the external story, and the external story is that China's great export and trade boom might be coming off the boil, and that was a key dynamo for China's recovery during the pandemic. I mean, we saw bumper trade numbers coming out of China. That's expected to come off the boil now. And by the way, that's expected to see even more of a decline as we head into later in the year when interest rates hikes around the world really do start to bite on household disposable income in the US and Europe. So I would say China is facing dual pressures now. Domestically driven ones, given their approach on COVID and what's happening in housing, and as you mentioned, slowing global demand.
Well, and on the subject of external things that China is dealing with, or at least are part of the China story, and what is your take on the developments over the weekend, the conversation between the defense minister of China and the defense minister or defense secretary of the U.S., and the conversation around Taiwan feels like it's escalating in quite dramatic fashion?
Well, you have to take it on face value. It's obviously very hawkish rhetoric, Kylie. It obviously demonstrates just how sensitive the issue of Taiwan is now between China and the US. I mean, you heard those comments from the Chinese defense official at the talks in Singapore. I think a lot of people also, by the way, are taking away from it that it's the context of this conversation, despite what's going on in Ukraine with the Russian invasion of Ukraine. There was a thinking that maybe perhaps China might mellow some of its language, might soften some of its tone, look for a meeting of ways, as China has in the past. But I think a lot of people today, their big takeaway from that was that there was no softening of that tone. Very hawkish when it comes to Taiwan. I would say, though, it's important to say there was also a message from China in that same speech that they are still looking to engage on the international stage. They do believe in that multilateral world order. So there were two messages, I would have to say, in that speech.
And thank you so much for the report from Hong Kong, and to Curran, of course, with Bloomberg News. I want to walk through the data, check there. Lisa, help me here. Futures negative 91, now negative 83, a little better support. The VIX is a 5-point X level, comes into 4, up 4.7, 4 points, 32.49. Lisa, I know you're watching NASDAQ percent as well, but the answer is it's a pretty even application of percent change in equities.
Yeah, and that's what you're seeing right now. Wholesale risk off, and this is really driven by by the bond complex. 2-year yields edging away from some of the highs.
13 basis
Yeah, but
points.
honestly, just such a huge move to the highest levels that we have seen since December 2007, 3.19% on the 2-year, on the 10-year, 3.23%. And if you take a look at that yield curve, yeah, we've avoided inversion, but Tom, it's getting really close, and it is dollar strength across the board. And how many notes did you read over the weekend, Tom, talking about how there's nothing to really stop it? I mean, at this point, given how much the Fed has to do, and given that they have not blinked yet, how do they really avoid dollar strength in the face of global stagflation?
And of course, the basket case of the moment, is outlined by OECD, is the United Kingdom. I believe they have a banking meeting this week. John Farrow's scheduled to be in attendance. And Lisa, moments ago, I had a 1.2200. We're going to get a 121 handle on sterling. This is a 14% drawdown, or 14% sterling depreciation off of the peak of another time and place.
And it highlights the angst of the moment for central banks, hiking rates into weakness. At what point does the weakness call their hand and make them think again?
Gold showing that growth scare, -15 on gold, 1861 an ounce, and Euro Swissy a 103 handle. Stay with us with futures at -84. This is Bloomberg on radio and television.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning.